Okay, welcome everyone to another bonus Mello Tuesday event. We do like to give you sector coverage, and this one this evening is on gold, metals, and mining. Certainly, we had a really good event in November on gold alone, and it's nice when we get a chance to cover a number of companies that we wouldn't otherwise see at Mello. It's not our standard Mello Monday event, of which many of you as annual pass holders obviously regularly attend. In this one tonight, though, we have a really international show. Amazing where all these companies have their bases, and amazing where the directors are speaking to us from tonight. Can you believe we've got presenters from as far afield as Vancouver, the US, Johannesburg, El Salvador, Wales, and Paris. So we're going to give you a really challenging show in some ways. We really do hope we can keep the connections going. I know one at this very moment is having an extra strength signal brought into his hotel room. So I'm sure we're going to have a really interesting show ahead for us. Anyway, I would like to also welcome 27 investors that we will have joining us this evening from the Tuesday show we had last week, which was on Woodford and the funds that they managed. And so it's really nice that you're coming back and joining us for one of our sector events. And we hope we'll be able to get you along to other shows as well. Remember, all of you, that annual passes are the best way to view Mello. An annual pass gives you free entry to all the events we have during the year. And this year, in a virtual world, it looks like we may have as many as 30 of those. So they're great value. But anyway, I would really like to introduce our first speaker. And I think really the best way to introduce John is to say that I needed somebody who would give us really good sector coverage, and John's name came up 3 times. So here he is, and welcome, John. And I had a chat with John, and he said he'd love to, which is great. And you've lined something up for us, I think, John, that will really introduce everyone to the sector.
Thank you very much, David. That's very kind to be asked to speak at such an event. And I've actually been to a Mello event up in Derby in the past, and I was very impressed by the quality of other speakers, better speakers that you've had, and in fact the good questions from the audience. So it's definitely an event that surpasses expectations. I'm here tonight to talk about the mining sector. I'm going to talk broadly about this, but we can easily go into some detail if required. And I think it's worth trying to asking the question: are we in a new commodity super cycle? Is one coming, or are we being led up the garden path with a big fat red herring? So I'll tell you what I know, and then as investors. And as company CEOs, you guys can decide. I'm fairly convinced that we are in the starting blocks of a new super cycle. Having been through the dot-com boom, having lived through the boom of 2005, 2006, 2007, before the subprime crisis hit us. And experiencing what we're in now, I'm convinced that we're in a super cycle. And we've all been through tough times as well, so we know what that feels like. But if we figure out, well, where have we come from? Well, the Industrial Revolution started several hundred years ago with the industrialization of the British and then the global economy. We went from water wheels. In fact, there was a water wheel on the waterfall just behind the house where I'm sitting now, on the River Glyme, heading down to Blenheim Palace in Woodstock. There were a whole series of water wheels driving industry back then. So it was water wheels and horsepower that gave way to steam. to combustion engines, and now we find ourselves moving on to green energy, renewable power generation, electric motors for transport, and in fact electricity being used to power an awful lot of things. I have to wonder what will come next. But for now, we're definitely in the era of the electric motor, the era of decarbonisation. That is definitely driving a driving force for change, and particularly as some of the extreme weather patterns that we've been seeing over the last year highlights the potential risk of climate change. Now, I'm not going to argue for or against climate change. I think it's up to everybody to make up their own minds. But certainly changing the way we travel and how we generate our power is being driven and is going to require a big rethink of our power networks. Also, of course, no talk would be complete without mentioning COVID-19. And that, of course, is going to accelerate the change, because there are quite a lot of people who've had COVID who have some, so we say, slightly longer lasting lung issues. Clearly, the hospitals are worried about people with blood clots, and people who've had COVID, many people who've had COVID, do suffer some impairment to their lungs. Hopefully that won't last any great length of time. But in the meantime, it's particularly important to ensure that the air in our cities is cleaner than it was. And we were already changing things before COVID-19 came along. So it is an acceleration of the change that we were coming into anyway. Changing the vehicle fleet and changing the way we generate power is, of course, highly metals intensive. And I'll come along with some statistics on that later on. But clearly, as we change as we install wind farms, as we install more solar power generation, as we bring in other forms of power generation, these are all we're just going to use an awful lot more metal in the process. It's not something where we're going to end up pouring a lot more concrete, although clearly wind farms use concrete to stabilize these enormous windmills. These things are more metals intensive than they were. Add to the mix the stimulus programs that we're seeing, the low interest rates, the stimulus funding, and the new project development that's being encouraged by all of that, particularly the wind farm development. And we are going to see, again, more use, more demand for the key metals: copper, nickel, cobalt, lithium, zinc. In fact, to be honest, it's hard to get away from it. And we're already seeing the impact of this increased demand on prices, and with metals prices back up to what are near record levels. In fact, close to the record levels that we saw in 2006 in many cases. So we are certainly heading into a new era for demand, a new era for metals pricing, and I think an era that is likely to be quite inflationary as well. And again, I'll get on to that. Now, some years ago, you may be surprised to hear that I worked with Edmund Shing, and we were in the strategy department at Goldman Sachs there. I'll try not to embarrass Edmund too much about that, but he doesn't seem to have changed much over the years. And we used to work with a great economist called Gavin Davis. And Gavin always used to say to us, how has the world changed? Well, clearly the world has changed, and I'm not referring to COVID here, but that is a change. I see that Tesla changed the world. Elon Musk, very clearly a very, very smart and driven guy. He demonstrated to the world what Sir Clive Sinclair failed to do. He demonstrated that electric vehicles were superior, were affordable, only just, of course. They're quite expensive, and actually were clearly much greener. Greta Thunberg also changed the world. She went and spoke at the United Nations and argued the case for climate change, for going green. I would also argue that cheap Chinese manufacturing has changed the world, because it's actually the competition from China, the competition for jobs and the competition to sell products, and in fact, the deflationary impact of Chinese goods has created a new race for economic superiority between the East and the West, and that is also changing the world. When I started working in the city many years ago, in fact, after I finished working in tin mines and gold mines in Cornwall and South Africa, I came to work for a Japanese financial newspaper, the Nihon Keizai Shimbun. And I remember well when Japan became a new economic power. In fact, you could argue it became a superpower, certainly economically, although not militarily. And there was a certain amount of friction with the rest of the world. I remember people smashing up Japanese cars, particularly Datsuns, because they were upset that their cars were better than our British Leyland Austin Allegros, if anyone remembers that. Now China is coming into into the global economy. It's come up the ranks very, very fast, and it is threatening to overtake Western economic powers in all sorts of respects. And it seems to have created a new race for economic superiority. So I think this is another potentially inflationary factor going forwards. Let's not forget that in order for Elon Musk to make his Tesla, there have been an awful lot of smaller technical innovations along the way. Many of these in their own way serve to change the world. We're talking about incremental improvements to electric motor technology, developments in battery management systems, and all sorts of things. There are all sorts of small innovations that have helped to make electric vehicles, wind farms, solar farms, all sorts of new technologies, just very much better than they were. So the world is progressing towards greater electrification as a result of this. It was a slow process, but it's now very much better, and it's all happening. So Elon Musk took Sony's lithium-ion battery technology, which they developed for camcorders. Okay, we should give some credit to the professors at Oxford University that developed the lithium-ion battery, but it was the Japanese that developed and commercialized the lithium-ion battery. And for many years, it was just something that we used in the camcorder, and then they started using it in power drills and things like that, and it became a more accepted commercial product, but it was always on a relatively small scale. Now what we saw was Elon Musk took a battery like this, an 1860 battery that you will use in a torch, for example, and he bolted a lot of them together and put them into the Tesla vehicle. He demonstrated that you could take this very simple little battery and do something pretty awesome with it. In fact, his first cars, they didn't even use they didn't use regenerative braking, they didn't use permanent magnets, and they still performed really well. It goes to show that actually an electric car almost sells itself. Many years ago, back in the 90s, I worked with the chief executive of Zetec Power. They were the leading fuel cell producer of the day. In fact, they were producing alkaline fuel cells, and which they had adapted from the fuel cell that NASA used in its Apollo rockets to the moon. So, in fact, the guy's still developing and enhancing those fuel cells, and that's a talk for another day. But he took a fuel cell, and he took a really rather rubbishy London taxi, an old metro cab, if anyone remembers those, and he turned it into a really sweet electric vehicle. It was so smooth, it was so quiet, it was a vehicle to behold. The problem was it had very short range. It was powered with a fuel cell, which was great, but of course it had to have small hydrogen tanks, because hydrogen is expensive to compress and difficult to store, and certainly difficult to transport. And it just used a couple of lead acid batteries to enhance the system. So back in the 90s, we didn't have access to the technology to manage and support a whole lot of lithium-ion batteries like this. But it proved that you could make a great car, and everybody would have wanted one if they could have had something practical. What made Tesla's car so good was all the other bits and pieces that he brought in. Clearly, he gave it enough range, but everything else that is working better. The LED lights don't take so much more energy. Other creature comforts, with the exception of the air conditioning unit, which still uses quite a lot of power, everything else is a lot more efficient than it was in the 90s, and therefore that means that Tesla could actually make a car that wouldn't use up the battery pack too fast. So that has changed the world. Of course, it's not just about cars. It's going to be about electric buses, electric ships, and electric dump trucks and things like that. So there's an awful lot of in fact, almost every piece of machinery in the world can be electrified one way or another. I gave a talk to the head of technical development for a major international manufacturing business, an automotive manufacturing business, the other day, and this was focused on fuel cells. They've already electrified their vehicles. What they're struggling with at the moment is how to power those vehicles, and they are looking very closely at using fuel cells. So they either want to swap in the battery packs in order to ensure that the machinery can carry on working for longer, or they want to put fuel cells into the system in some way to power these vehicles. Because what's important is if you can use hydrogen to generate your power, not only do you have less reliance on the grid, effectively you can go off grid, but you can also generate that power without taking power through the grid system, which is going to be another problem because there's going to be so much more power used by consumers if our vehicles are going to use electricity. So there's going to be a lot of change, and change always comes with risk. And one of the things we've learned is that, for example, if you took a Tesla and you drove it across really rough ground, and I'm being careful what I say because I don't want to get sued by Tesla, but I suspect you might have some problems with the battery pack after that, because of course if you've got a lot of little batteries bouncing around, you're going to break the soldered connections. Now, in fact, Tesla have been remarkably good with their battery pack, so I think they seem to have cracked it. But we would be interested to see how the new Tesla Cybertruck does when it's tested over rough ground, because it may start to struggle. Also, what we learn is that the copper cabling in these vehicles, with respect to that, there's a sort of theoretical amount of copper that you might use, but what these companies find in practice is that you need to put quite a lot more copper into the cable in order to make a properly functioning working vehicle. Now, I'm not quite sure what the reason is for this, but they just tell me that actually you do need to beef up the copper cables quite a lot in order to carry the power around. Now, maybe this is due to peak power requirements on the motors. Maybe this is because people turn on the air conditioning system when they're accelerating. Who knows what it is? But for whatever reason, they seem to need to beef up the copper cabling. So as I say, it all comes with risk. Electric vehicles and the change from gasoline and diesel to electric vehicles is going to be expensive. Governments want us to buy electric vehicles. They want us to have cleaner air to breathe, which is good. That will hopefully help to reduce costs of healthcare going forwards. They're also buying cleaner buses and trains. They want to persuade taxis, delivery men, builders and contractors to all go green, and I'm with them on that. And this means that they're going to have to incentivize everybody somehow. Now, we're in a world where governments are already borrowing a lot of money. The governments are also seen as responsible. They're not just seen as responsible for healthcare, but they're responsible for providing electrical power. One of the things that gets a politician voted out of power really fast is when the lights go out and they don't immediately come back on again. So rolling power cuts might be acceptable in South Africa, where Anthony lives, but not so acceptable in the UK. And if you remember back to just over a year ago, there was a big power outage in the UK when the wind was blowing a bit too strong in the North Sea, and one of the big offshore wind farms had to shut down, and when one of the gas peaker power plants failed to come in, and hundreds of thousands of people got stranded on trains that stopped just on tracks all over, mainly in the south of England, I think. But that's clearly unacceptable. I think the government got away with it once, but I'm not sure they're going to get away with it 2 or 3 times, in a year, for example. So sadly, I think governments are going to have to continue to print money. I think the cost of the metals for the new electrical generation that we're moving into will drive inflation, and I just don't think there's any getting away from this. So it's worth mentioning that actually cylindrical cells like this are giving way to prismatic batteries. This is often called a pouch cell, but prismatic batteries. They do have heat management issues, which we could go into. We wouldn't want to embarrass the manufacturers that have struggled with them. But we noticed that some companies are moving over to prismatic cells. In fact, Volkswagen announced that yesterday, that they were going to move to prismatic cells, and they're going to work with one of the big Chinese battery producers on that. So it's clearly a lot of good engineers working within Volkswagen, including one of my former colleagues who's gone in there to work on sourcing some of their battery materials. So these are interesting times, but I think the challenges of getting all these sorts of different types of batteries to work is going to result in quite a lot of recalls. We've already seen some big recalls in South Korea. Not a surprise there, because South Korea is, well, let's put it this way, I think their companies are just slightly less precise than the Japanese, and maybe even less precise than the robots that make things for Tesla in the United States. So I think one's going to have to watch out for that. And of course, big recalls, particularly in Europe, are very expensive. So I think that's something else to look out for. If Volkswagen heaven forbid, had a massive recall of their next generation of electric vehicles, I think that would require a bailout all on its own. So power generation, again, we're going to have to beef this up. Great for local UK stimulus, an absolute brainer no-brainer for the government from a stimulus and a balance of payments perspective. Means we'll be importing less power, hopefully, from Europe, importing less raw materials for generation of that power. So, and if we're building those windmills at home, and the government's clearly working on that with subsidies for a new big windmill factory up in Scotland, then that's good. I think we'll also see a new generation of vanadium redox batteries coming in for grid support. Those batteries will be needed for when the sun's not quite so strong, and when the wind's either blowing too hard or when the wind's not blowing enough. So as we decarbonize, we need to put in more battery packs. We'll be using end-of-life batteries off the next generation of electric vehicles, and I think we need to put in the vanadium redox batteries to support the grid over a slightly longer term period, because that's what they're good at. So grid power lines, I'm sure will need upgrading. The overhead lines are aluminium, but anything underground, it tends to be copper, and particularly the cables connecting the wind farms, the turbines on the windmills, and then the wind farms to the grid. They generally come in at big, heavy copper cables. So there's a lot of new metal to be used there. I'm also the grid is going to want to persuade us all to go for more distributed power. That's more solar panels on houses, and I'm looking at signing a contract for a borehole ground source heating system here to replace my oil-fired system, which is a bit antiquated. And the government is almost certainly going to add greater taxes to petrol, diesel, gas, and heating oil in order to persuade us to decarbonize. So I think this is stuff that we're all going to have to be more cognizant on. New housing developments are going to become are going to be supported by ground source heat pumping systems, often from boreholes, because that's normally a better way of doing it, although it's got a bigger upfront cost, sadly. But this will make us even more dependent on the electricity and its generation. So somehow I think we're going to have to try and generate a bit more electricity on a distributed basis and generate a bit more locally. So if we start to try and quantify all this from a metals perspective, there are various numbers that we can throw out at you. For example, and estimates do vary, but there'll be somewhere between 200 and 500 kilos of neodymium and praseodymium to go into each offshore wind turbine. These wind turbines are getting bigger, almost every week. I think the latest one was 14 megawatt wind turbine. And that's an absolute monster. That will supply power for hundreds of thousands of houses, but it will only supply the power when of course the wind is turning, and the wind is turning so the wind is turning those turbine blades at certain wind speeds. So they'll get the neodymium and praseodymium is used in the permanent magnets. That gives greater efficiency and reliability, but of course it's expensive. You don't mind the cost so much when you're installing something out at sea, because it's just an expensive thing anyway. And you're not going to mind the cost of the copper. And as an investor asked me about an hour ago, before I came onto this, where is all the copper going to come from? And I'm forced to say I don't really know, because it's not very easy to ramp up copper production. Yes, the copper mines can do it on a short-term basis. Yes, if the price stays over $10,000 a ton, that more marginal copper mines will come in. But will it really be enough to support the demand the world will need? I think what will happen is there'll be a certain amount of substitution. Air conditioning units, for example, will go back to using aluminium pipes rather than copper pipes. I won't be buying one, because I think, what's the point in running an air conditioning unit if it doesn't have a copper pipes in it? Because that makes it much more efficient. But certain other uses will have to switch to lesser materials. Yes, automotive batteries will get better from a capacity and a range perspective. We saw Elon Musk announcing their next generation of cylindrical cells. And although these have greater capacity and in theory greater range, they weren't quoting a much greater range. And I think this is in order to improve the reliability. In fact, your average Tesla battery pack could double the range of the vehicle, but they only use about half of the capacity in order to preserve the life of that battery pack and make sure that you can run that for something like 8 or 10 years. And in fact, their battery packs have done remarkably well. It's very impressive what they've done with the technology. Now, we saw that recently UBS reckoned that electric vehicles will account for about 40% of all new car sales. So in 2019, which is the last sensible year to look at, there were 93 million vehicles sold. Now, if just 10% of those cars are electric vehicles, then we get some extraordinary statistics. I mean, we don't have enough lithium to fill all those battery packs. It will account for something like 15% of the world's nickel supply, and there isn't a lot of spare nickel, let's face it. It gets worse when you look at cobalt and more exotic materials. So we are wondering where it's going to come from. I think what will happen is metals prices will carry on. They'll either remain strong or they'll carry on rising, and I'm afraid that underlying commodity price inflation is going to push up end product prices. It is going to drive inflation. It won't be the only inflation driver. Lower capacity utilization from social distancing, higher labor rates, which are typical after a pandemic, and the effect of excessive money printing means that inflation is coming our way, and we're just going to have to get used to it.
Oh, right. Thank you, John. That was perfect timing. You're going to be joining us on the panel as well later, so you'll be pleased to know there's already a number of questions up here for you, but I'm sure you'll be getting those on the panel. So anybody on the webinar, we've now got nearly 300. If you want to ask a question, do put it into the Q&A box, and we will either ask it at the end of each presentation or in the panel session. Great, and now we have our first company. Caledonia Mining, and Mark, you're here. Where are you from currently, Mark? Because we've got an international show here.
Well, I hate to disappoint you. Ordinarily, I'd be in Jersey, but I got a ferry last night, and I'm in the city of London at the moment.
Oh well, you're closest to home, yeah.
Yes, I'm sorry. That's not particularly exotic for you, but I'm sorry.
Oh, everybody else will do all that. Don't worry. It's good that you're in London. We need somebody at home.
Yeah. Okay. Well,
Great.
Just to link in with, sorry, this doesn't seem to be moving. So just to link in with what John was saying, John was clearly mostly talking about demand for industrial metals, copper and lithium and cobalt and what have you, but we're a gold producer, and just where John ended off was some quite chilling discussion about the outlook for inflation, and that really links into gold as a sort of a store of wealth and a hedge against inflation. And I'm very happy to tell you that we're a Zimbabwean gold producer, so inflation bears no fears for me at all. Now, what you see here, I can run through this very quickly in about sort of 15 minutes. And leave plenty of time for questions and discussions later. What you see on this front slide is actually something we're very proud of. It's a new headgear that we put up over the new shaft. This headgear went up in January this year, and this will be allowing us to increase our production to 80,000 ounces of gold a year. So it's a very exciting picture for me. Right, here's the disclaimer. Right, so our strategy is focused on really four elements. It's the central shaft, as I've already mentioned. It's a project we've been working on for many years. Very, very nearly finished now, and then it'll be commissioned in the next few weeks. And that really delivers near-term low-risk growth in the context of mining, which will allow us to substantially increase our production from last year. We did 58,000 ounces, and by 2022, we'll be looking at doing 80,000 ounces a year. So increased production, also reduce our costs and reduce our capex. So a very substantial increase in our cash generation. We've also demonstrated over the last nearly 10 years now a de facto commitment to return money to shareholders. We pay a dividend quarterly. We've done that many years now, and for the last sort of 5 or 6 quarters, we've now been increasing that dividend. So there's a slide coming on in that coming up on that in a few minutes. And we're also now beginning to look at some attractive new investment opportunities in Zimbabwe, where we feel now able to deploy some, but not all, of the surplus cash that we're generating. And also we got more management capacity now to take on new projects in Zimbabwe. So just by way of an overview, we are an established profitable gold producer with the Blanket mine in the south of Zimbabwe as our main asset. Late last year, we entered into 2 option agreements in respect of exploration properties in the Gweru area of Zimbabwe, which is in the Midlands, an area that has historically been very good for gold production. The company, it's a Jersey company, Jersey, the Channel Islands, which means that it's tax neutral. Our dividends don't incur withholding tax, and we don't, whilst we cheerfully pay tax in the countries where we've got operations, such as Zimbabwe and South Africa. We don't get caught by, pesky taxes on unrealized or realized foreign exchange losses and gains at the head office level. We're listed on NYSE, which is where by far the bulk of our trading is. So yesterday, about $3 million worth of shares were traded on NYSE. Also listed on AIM, where liquidity is much lower for reasons we don't really understand. We had just over $21 million of cash at the end of September 2020. We'll be putting out our full year 2020 results on Monday next week. So clearly I can't talk about our closing cash position at the end of December. And we're based on our Q3 earnings annualized, we're on a PE of about 12.5. So we don't feel to be overstretched in value terms. This coming year, 2021, we'll be looking at production guidance of between 61 and 67,000 ounces. That depends very much on the pace of commissioning of the central shaft. And then from 2022 onwards, we'll be producing 80,000 ounces a year. In terms of our resource base, we had measured and indicator resources of just over 800,000 ounces at 3.7 grams a ton, and then almost 1 million ounces of inferred resource at 4.5 grams a ton. We've always had a very high conversion ratio from inferred to M&I, and it's fair to say over the last few years, for reasons that will become evident, we've really not had the logistical capacity to do further exploration at depth. So with the opening of and the commissioning of the new central shaft later on this year, we're very confident we can resume deep level drilling and extend that, increase that resource base and extend our life of mine, which currently runs out to 2034. So we don't feel resource constrained. I've mentioned our dividend. For many years, we paid a dividend of 6 7/8 US cents a quarter, which is quite difficult to say. And then we increased that to 7.5 cents, but partly because of the higher gold price, but also because as we were coming to the end of our capital expenditure program, we became increasingly confident about our cash position. So we increased our dividend to 7.5 cents in January 2020. We would probably have increased it again in April 2020, but with the onset of the coronavirus, we thought it prudent to just hold fire a bit. So we deferred the dividend by 4 weeks so we could get a view of the lie of the land. And when it became apparent that coronavirus wasn't having a significant effect, we repeated the dividend at 7.5, then we increased it to 8.5, then 10, then 11, and our next dividend announcement is due early in April. So a long-standing commitment to pay a quarterly dividend, and our current yield is about 3.2%. This is, you may find this interesting, you may not find this interesting, but what we did is we just took the constituents of the GDXJ index. So that's a sort of a gold junior index, although some of the companies are actually quite big. And we plotted for those companies that pay a dividend, their dividend yield and the Bloomberg consensus growth forecast for the next 2 years. And you can see we're something of an interesting outlier in that our yield is by no means the highest, but it's towards the higher end of the pack. But significantly, our 2-year compound growth is very much towards the top of the pack. And we believe this really means that Caledonia is an almost unique proposition in terms of yield and growth. Now, clearly, you can make of this what you will. But I think it's an interesting sort of perspective on how we differentiate ourselves and how we are different from other gold producers. By way of background, you see on the left our share price. Our share price shot ahead in New York in the middle of last year, partly because of our inclusion in something called the Russell 3000 index, which gave rise to buying by passive funds, in particular BlackRock. That's that BlackRock shareholder have got almost 5%. That's a passive investment. That created momentum, which was latched onto by retail investors in the US, and that pushed the share price up to about $27 a share in August, September. And actually, to be frank, to arrive at a share price of that level, we would have had to apply a discount rate of 1% to our forecast cash flows. And whilst I'm optimistic about our business and optimistic about Zimbabwe, 1% is on the low side, eh? So it's probably fair to say that we were overbought at that point. Since then, our share price has come down to $14 or $15, and I think that puts us back into territory where we are possibly undervalued. In terms of the shareholder structure, management directors have got 4%. Alan Gray, for those of you who don't know, they've got a 16% shareholding. They are a very, very substantial South African institutional investor, alongside people like Old Mutual and Sanlam and people like that. So very well known in South Africa. Sales Promotion Services, they've got 5%. They are a Liechtenstein-based private investor. And Fremiro Investments, they are a group of Zimbabwean individuals who used to be a shareholder in the mine itself, and we flipped them up to the top company level early last year. And then a name you may recognise is Premier Miton. They've got literally just a smidgen under 3%. We've got 12 million shares in issue, virtually no options, 28,000 options, cash of 21 million, and no debt. We take our environmental, social and government obligations very seriously. We'll be publishing our inaugural ESG report later on this year. I think the critical thing to say to this slide is that we own 64% of Blanket Mine, 10% is owned by the workers, 10% is owned by the community, and 16% is owned by the government. They all have board representation at the Blanket Mine level, and we find that creates a very transparent, wholesome and healthy relationship, in that difficulties that may arise at the mine level are very transparently made very transparent to the community, the workers and the government as well, so they can see the real life impact of the environment that we work in. Just a slide on COVID. The sort of strap line to this will be it's had very little effect. It had no effect on production. It had a minor effect on our operating costs, but it did have an effect on the progress on the central shaft. So during the course of the various lockdowns in Zimbabwe and South Africa, we were unable to move people and equipment from Johannesburg up to the mine and back again, and so we just couldn't get the thing finished. And so instead of the mine the shaft being commissioned in October, we expect it will be commissioned later on this month, or perhaps early in April. So very little effect on COVID. And just by way of example, this is a clinic. We built an isolation clinic for the local community at a cost of nearly $500,000. In the middle of last year, we decided to press ahead with a solar project. About the only really significant operating difficulty we encounter in Zimbabwe is a very unstable electricity supply. We get power outages, and we also get peaks and troughs in the voltage, which can damage our equipment. And so we can and we do run off diesel gensets as necessary. We can do everything using diesel, but it is somewhat expensive, and it clearly has an adverse environmental effect. So mid last year, we took a decision to embark on the first phase of a solar project, a 12 megawatt solar project that will provide about 27% of Blanket's average daily electricity requirement at a cost of about $12 million. And because we wanted to press ahead with this quickly, and we didn't have $12 million at the time, we raised that through an ATM offering in the US. And this project is embarking right now. We will do a second phase, which will provide all of Blanket's use requirements during daylight hours, but that will require us to enter into an agreement with the government to sell surplus power that we produce from time to time, and that just will complicate stuff. Let's just get the first phase done, and then we'll proceed with the second phase later. So really the meat of the business is this central shaft, which I've mentioned before. What we've done is we've sunk a 6 meter diameter 4-compartment shaft in a single drop from surface to 1,200 meters. So to put it in context, that is 4 times deeper than the Shard in London is high. We finished the shaft sinking in July 2019. It was equipped late last year, and we're now busy commissioning it. And as you'll see in a moment, that gives us access to the areas below 750 meters for mining and exploration. So that will allow us to increase production, reduce our costs, and also do more exploration work. And that's cost us about $63 million since January 2015, which we funded completely from internal cash flows. And here you see a long section of the mining area. So that's about 3 kilometers from left to right. The heavy black line on 22 level, that was previously the bottom level of our operations. And you can see that on those ore bodies above 22 level, above 750 meters, a lot of it's gray, which means that it's stoped out. This mine's been running since 1907. So it's hardly surprising we're beginning to run out of material above 22 level. And what you see here is just coming in green. That's the infrastructure that we acquired when we bought this mine off Kinross in 2006. So it's the number 4 shaft, and then horizontal development towards the left-hand side. And you can see immediately this shaft's kind of in the wrong place. It's not really in the middle. And our workers sometimes have a 2 or 3 hour walk if they're coming down the number 4 shaft to get to their place of work on the left-hand side. They do a day's work, then it's another 3 hour walk back again. So it's inefficient and tiring. The central shaft is what we've put down. It's in the middle of the mining area, and then we'll have horizontal development on three levels in 2 directions. And you'll see immediately that opens up deeper areas for production and also for further exploration. Then just a word on our new opportunities. Zimbabwe, until the 1980s, was Africa's third biggest gold producing region behind South Africa and Ghana. And really since then, nothing has happened in Zimbabwe, primarily because of some disastrous economic policy. So the gold's gone nowhere, but Zimbabwe's not had the exploration spend lavished on it that has happened in many other jurisdictions. So we think it's probably the last really attractive gold exploration jurisdiction in Africa. And late last year, we got our hands on two new properties. The first one here is Connemara North, which you can see indicated on this map. We've spent $300,000 to get an option over an 18-month option to go exploring. And if we like what we see, we can then exercise that option for a fee of $5 million. The Connemara asset was previously, the Connemara North asset was previously part of a slightly bigger package that was owned by First Quantum, who placed the mine on care and maintenance in 2001 because of the deteriorating economic situation in Zimbabwe, and was then disposed of. But they actually prepared a feasibility study which showed that this mine was economically viable when the gold price was in the 300s, so nothing near the current price. Then the second asset is called Glen Hume, which is about 30 kilometers from Connemara North. Same structure and option agreement. This time we paid about $2.5 million up front, with a similar payment if we decide to exercise. And that's a 15-month option period, and the drills are already turning on that. And hopefully we'll be putting out some drill results later on this year. In terms of CSR, we focus on education, health, agriculture. So that picture you see there, that's a market garden project that we support. Environment, we have an extensive tree planting thing, and we also engage the local community, women and youth in particular. So the lady you see there with the sewing machine, she's producing PPE equipment, which we then buy off them and use on the mine. So we think we do probably more than many other companies of a similar size in African jurisdictions. So in terms of the outlook, we've got an increasing production profile up to 2022. Higher production, lower costs, reduced capex should substantially increase our cash flows. We expect to continue doing deep level exploration, so we believe we can extend the mine life out beyond 2034. We've demonstrated that we're a consistent dividend payer. We've demonstrated that we're prepared to increase the dividend. And as I've said earlier on, as we grow our cash flows, we're prepared to share those increased cash flows with shareholders and deploy some of those increased cash flows into new projects. In terms of research, in the UK, you can get research from WH Ireland. Paul Smith does a very nice note. And in the US, I don't think there's anyone in the US on this call. Cantor's produced a note in the US. So with that, I can pause there and we can perhaps take any questions.
Great, thank you, Mark. Camilla may be joining us as well, I think, but I'll get the ball rolling straight away with you. Irving asks, how have you avoided the Zimbabwe government interference? Zim policy has been to demand at least 50% share in any large business.
Yeah, that's a good question, but it's actually many years out of date. So we did comply with that policy in 2012. And so when I mentioned the ownership structure of the mine, I said that the workers have got 10%, the community's got 10%, the government's got 16%, and previously another bunch of Zimbabweans had 15%, which added up to 51, so we were 49. The very first thing that Emerson Mnangagwa did when he came into power was to roll back and actually remove that indigenization legislation, and we took advantage of that by buying out one of the partners. We have made an offer to government many times to buy out their 16% stake. They're willing, but they just haven't got the capacity to do a deal. No one in the Zim government is going to take the commercial risk of selling an asset. It's just too difficult for them. So Zimbabwe government has completely backtracked away from a local ownership requirement. And actually, in terms of day-to-day interference in the operations, the Zimbabwe government is conspicuously absent. Where the Zimbabwe government does make things very difficult is their interference in the exchange in foreign exchange movements, which is basically my job to deal with that. But Zimbabwe, other than that, you know, the Zimbabwe government is not as problematic as you might imagine.
Good. And Edwin in Edinburgh says the gold price is clearly off 17.5% in the last 6 months in sterling terms. How sensitive is Caledonia to the international price?
We're not, actually. So because we're not a low cost producer, we are not one of those sort of highly leveraged gold plays. If you're wanting to take advantage of that sort of leverage, you really should be investing in high cost producers, which will, you know, whose profits will increase exponentially if the gold price goes up. But unfortunately, if the gold price goes down, they close down. So that we're just not. I'm proud to say, and I'm pleased to say that we're not that exposed to the gold price. Clearly, it has a benefit to us, but we can run this business cheerfully if the gold price goes down to $1,000 an ounce.
Great. And someone here says, you mentioned that you think the company is perhaps slightly undervalued at the moment after the strong move up last year. What measure do you think is the most important to use for this calculation?
Well, the one that we use, but other people can't because they don't see it, is we know what our cash flows are going forwards, and we've done our best to communicate those cash flows to the analysts. So in particular, people like Paul Smith, and in the US, the Cantors analysts, we make sure they've got a very good idea as to what our future cash flows are going to be. And so the internal mechanism we use is we say, what discount rate would you have to apply to those future cash flows to get to our share price? Now, when I started this job in 2008, the discount rate you had to apply to our future cash flows to get to our share price was 90%. I'm pleased to say that's come down a bit, but currently the discount rate you have to apply to our future cash flows is now about 15%, which we think is too high it misprices the risk. I think the easiest metric for people who don't have the benefit of a cash flow model would be our yield, and we think a 3.2% yield is it's on the high side.
Yeah. And
especially when you factor in the clear potential for dividend growth.
Yeah. Peter asks, is it a year to 15 months enough time for new prospects?
It is. We only need to do enough work to make a go, no go decision, buy these people out, and then get on with it. 15 to 18 months may not be long enough to get to the end of the exploration story, but it should hopefully give us enough to make an informed decision.
Yeah. And Kieran asks, when will the central shaft be fully up and running?
Well, it should be commissioned either by the end of this month, which is only sort of 2 weeks away, perhaps early next month. Commissioning means that then we can start to run the skips at full speed. And once that happens, once the skips are running at full speed, then as far as I'm concerned, that shaft is operational. And then we can get down to the business of hoisting serious amounts of initially development waste and then subsequently gold-bearing ore. So within weeks.
Great. And John asks, what is the AISC? And for the benefit of many of us on here, including me, you'd probably be best to tell us what AISC stands for.
Yeah, the all-in sustaining cost is that short, the all-in sustaining cost, and that reflects the on-mine cost, so wages, electricity, consumables. It also reflects the head office costs, so that's the cost of me here in Jersey, and it reflects also the cost of the sustaining capex that you need to spend to keep the business running. Okay, so it specifically excludes any capex associated with new growth. Okay, but it also includes the government royalty, what have you. So our historic all-in sustaining cost has been in the 900s. We expect that to come. And clearly, I can't talk about what full year 2020 was because we're putting those results out on Monday. But when we get the central shaft up and running from 2022 onwards, we do expect that all-in sustaining cost to come down into the I thought the high 700s as a result of economies of scale and genuine reductions in operating costs. So that puts us towards the sort of lower end of the cost spectrum.
Yeah. And Andrew asks, given the historical unstable political environment in the past with Zimbabwe, how confident are you that given steep inflation and shortages of materials, the government would not grab production facilities or increase taxes on you?
So would not what productions? Just say the last bit again.
Well, he thinks grab production facilities.
Okay. All right. So we inflation doesn't worry us in the slightest. In fact, actually, when inflation was running at gazillions and gazillions of percent, in fact, I've actually got my wallet. I've got $100 trillion note. You know, the last time we paid our workers we couldn't pay them in Zim dollars in 2008, 2009. And we just physically couldn't get enough Zimbabwe dollars to pay them. So we paid them in diesel. And at that point, the wages for 450 workers for 2 months was a 2-gallon tin of diesel. Okay, so the people who got hurt from inflation isn't ours, it's the workers. All right, let's be clear about that. We're a dollar earner, and so our revenues come in dollars, and we pretty much spend in dollars. Nearly all of the consumables that we use, we import ourselves from South Africa, so we guarantee that supply chain. So inflation and local supply doesn't really worry us at all. And insofar as worrying that the government's going to turn up and take the mine off us, that's just not going to happen. They cannot run a complex, deep-level mining operation. It's just not going to happen. They can't do it. They tried to take over the farms, and everyone thinks they can run a farm. It's just growing a bunch of mealies and herding a bunch of cows around the place, and they couldn't do that. So I do not worry about government grabbing the mine off us. That is not a major concern for me at all.
Has it changed over the years while you've been involved with Zimbabwe, or how? Yeah, it has. I mean, initially, the general climate and
initially,
just your experience of dealing with officials.
Yeah, it has changed. The officials, let's be clear, the officials are highly educated, highly competent people who work under extremely challenging conditions. So when you're dealing with the officials, you're not dealing with corrupt sort of people who don't try to do their jobs and don't know what they're doing. These people typically do their best under very hard circumstances. It's fair to say that when Mugabe was the president, the difficulty we had, it was irrational. It was irrational and utterly ruthless. And what's happened now is, where the government may still be ruthless, it's completely rational. And they understand entirely that Zimbabwe needs people like Caledonia to earn the foreign exchange that the country needs to keep going. And there's no. We've had conversations with the minister, with the president directly, with the Minister of Mines regularly, and that's clear to us. And they need us to succeed, to drag their country from the mess it's got itself into. So we're not unduly worried about that. Things have improved. Whilst the Zimbabwe, the fact is Zimbabwe is a very broken economy, very broken society, and that creates challenges. But in terms of an antagonistic, voracious government, even jacking up taxes, the tax regime in Zimbabwe has been very, very stable for as long as I can remember. We've not had the shenanigans that you've had in, say, Tanzania.
Great. And tell me, Mark, when people, I don't know if they have pubs in the same way in Zimbabwe, but when you go to the bar, does everybody rush to buy the first drink because they know the next round will be double?
No, not really. they rush to the bar to buy the first drink because they're mainly a bunch of alcoholics. The bars are busy. The bars in Bulawayo are very, very busy, I've got to say. They are very good at enjoying themselves. And actually, Bulawayo is a very convivial place to go to. I love being there.
Well, we've come to the end of our time, Mark. Thank you very much for answering all those questions. I'm sure the audience, and we've nearly 300 now on the webinar, they're a lot more informed about Caledonia and also the way things operate in Zimbabwe.
Well, our contact details are on the back of that presentation. We are open to, if you send us emails, we do our best to respond, and so we do try and be as open as possible. Okay.
Brilliant. Thank you, Mark.
Thank you. Thanks.
Great. Now we have another presentation. We have Taseko next. I think it will be pronounced that way. Maybe Taseko.
Great. Yeah. Hi, David. Yeah.
There you are, Stuart. Yeah. How do you pronounce it then, Stuart?
It's Taseko Mines. Yeah.
Great. Great. Well, this is certainly a company that I know a lot of the investors won't know too much about. So I hope you're going to be able to give us a really good presentation on them. I'm sure you will. And we'll have a Q&A with you as well at the end. Great.
Great. Okay. Thanks, David. And yeah, thanks for having us, and thanks for the opportunity to present to your audience. Yeah, I'm Stuart McDonald, the president of Taseko Mines, and I guess what we're a Canadian-based copper miner. We're building a multi-asset copper producer in top mining jurisdictions, British Columbia and Arizona in the U.S. We've got an experienced management team with a proven track record of operations. We currently have one producing copper mine, which is the Gibraltar mine in central BC. It's a long life asset with that provides us a very good cash flow base to grow the business from. And it's got a long remaining mine life as well, 18 years of reserves ahead of us. So it's an established operation and as I said, a great base for us to grow from. Our next mine that we're currently getting ready to build is the Florence Copper Project in Arizona. And this is one we're quite excited about. It's a near-term, high-return project. Very attractive economics with low capital costs, a long mine life, and an attractive cost structure. And I would say quite a unique production method there that allows us not only to have great economics and low costs, but also a number of very positive environmental attributes. And so we're going to be able to produce green copper with a very low carbon footprint and deliver that refined metal right into the US domestic market in the next couple of years here. So we're quite excited about that near-term growth. And beyond that, we do have a pipeline of longer-term development projects as well. Yellowhead, New Prosperity, and Alley. Each of those they're not exploration projects. We're not really in the exploration business. They are identified deposits with proven and probable reserves, and they're in various stages of permitting. So if we can work away quietly on those projects for the next couple of years, and potentially we have a third mine that is shovel ready in a few years coming behind Florence. So we've got a great growth profile ahead of us. We have a lot of leverage to copper, of course. We like the metal, both from our existing cash flows and also from our portfolio of reserves with 15 billion pounds of copper in reserve. And I think what is also quite unique about our company is the jurisdictions that we operate in. We like to operate in first tier jurisdictions. Canada and the US, of course, established rules of law, and we haven't had to go to more challenging and riskier jurisdictions around the world where a lot of the new copper deposits are being found. We've got the reserve base right here in Canada and North America. So a few comments on copper. Of course, I think John earlier in the evening here did a good overview of some of the demand dynamics that are at play, and of course this trend towards electrification of our economy and electric vehicles, renewable energy. All of that requires electricity, and electricity generally needs copper as a primary conductor. So the demand story here moving ahead for the next 5 to 10 years is very positive, but I think maybe what some people maybe don't fully appreciate is the challenges that the mining industry has in keeping up with that demand growth. And it continues to be very difficult in the industry to bring on new mines of scale. So we have this growing, and so as existing mines, production from existing mines tends to tail off towards the end of mine lives. We see this growing deficit in the market, this growing shortage of production. And we think that in order to fill that In order to close that gap, sure, there may be a little bit of substitution, but we think that there needs to be a much higher incentive copper price to incentivize new mines to be built. And whether it's $4 or $3.50 or something in those ranges, you know, it's really those kind of levels that incentivize mining companies to build new mines, because building a new mine can be a risky endeavor, particularly if it's in a challenging jurisdiction. So we like the fundamentals, and we like where we're positioned today with our business. So this is a picture of our granite pit at our Gibraltar mine, where we've been mining essentially for the pit. We've been mining essentially for the last 8 or 9 years, up until last October, where we finished. As I said, it's a large-scale operation. We mill about 85,000 tons a day of ore here, and you know, as I said, it's a stable, long-life asset. So we restarted the mine in 2004, went through a major modernization and expansion period, and really the thesis of that investment was to get the mine to where our cost structure is sustainable through the copper price cycle. So we produce today roughly around anywhere from 125 to 140 million pounds a year of metal. We can do that at a cost of around $1.80 or $1.90 per pound of copper. So that gives us a very good margin. Yeah, you know, it's been a great asset for us over the last 15 years. Produced $900 million of operating cash flow since the restart. We also are, you know, take our ESG, you know, and our health and safety very, very seriously. The mine has won the John Ash Safety Award in BC here 4 out of the last 5 years. We've been recognized for mining and sustainability by the province, and so, you know, we think we're good operators, and you know, good at what we do here. So costs at Gibraltar, when we look at the efficiency of the operation, it really is one of the lowest cost open pit mines in the Americas at just over $8 a ton milled. We have to be very efficient and good at what we do here because it is a lower grade ore body. So we get there with a skilled and efficient workforce, great access to infrastructure in the center of BC, you know, whether it's hydroelectric power, you know, we're right on the grid, we're right on the rail line on the highway. We're near 2 major towns that provide access to all the supplies that we need. So that keeps us, you know, allows us to keep our costs low and be efficient. And I think we've shown some of the flexibility in the operation as well, and to respond to some of the copper price volatility that we've seen even over the last year. With the price falling last March, we were able to adjust and get through that. Made some short-term adjustments to our mine plan, and you know, got us through a period of low copper prices. And of course, in the last 6 months, we're really seeing the copper price recover, and it's very positive for our earnings. So if you look at 2020 as a whole, we had 108 million Canadian dollars of EBITDA, a similar amount of operating cash flow. That was off a base of 123 million pounds of production last year. Moving to 2021, you know, we think we're well positioned. We should be able to increase our copper production slightly up to 125. But you know, the bigger story, of course, is what's happened now in copper prices. So the average price last year was about $2.80 a pound. We're now over $4 a pound, and you can see in the chart on this slide 8 of, you know, that leverage that we have, that sensitivity that we have to an increase in copper price. So at today's copper prices, we would have produced over $250 million of EBITDA last year. That gives us a lot of upside here in the current environment. So moving on to Florence. This is our growth project that I mentioned, and this is an overhead photograph of our well field at Florence, and you can see it's not what you would expect when you see a picture of a mine. We're not digging a hole in the ground here. We're actually drilling a well field into the ore body, and injecting a solution to which is going to recover the copper for us in solution. So it's a very exciting project. We've been operating a test facility here in 2019 and 2020. We've produced over 1 million pounds of copper from we call it the PTF, and we're just now on the cusp of expanding this to a commercial scale operation. And once we do that, the economics of that commercial facility are very attractive. These are the results of our feasibility study from a couple of years ago. You can see this will, for a capital investment of about 230 million US, that's going to give us a 21-year mine life, 85 million pounds of copper per year, and very attractive IRR and quick payback, and low operating costs. Operating costs below $1 a pound, or mining costs, if you will, below $1 a pound, which is really first quartile, on a global, comparing to global mines. So very excited about this. I think the reason we can achieve those economics is really tied in with our mining method. This is in situ copper recovery, as I mentioned, and there's a schematic here on the slide of how we do that. We're injecting a diluted sulfuric acid into an injection well. We have a highly fractured ore body. It's almost like rubble or gravel, and it's also saturated with water. So these are the perfect conditions for this type of mining method. So when we inject our mining solutions, they permeate out through the ore body, recover copper in solution through the leaching, and then those copper-bearing solutions get sucked up recovery wells. Once it's on surface, once the solution is on surface, we process it through a conventional SXEW plant, which is conventional mining, a conventional way of recovering copper. Normally, of course, in a copper mine, you would mine the ore, place it on a leach pad, and then irrigate it with your leach solutions. But we have the right conditions here to do the leaching in situ. So it's that provides us with low cost, of course, but also a number of very positive environmental attributes. We don't have, we have a very small footprint here, very little surface disturbance. You can cap these wells once we're finished mining, and you can have a park or a golf course on this property in 25 years. It's and also very important for our future customers, we can produce copper here with very low carbon emissions, about 85% lower than a conventional copper mine. So we're not using heavy equipment, we're not doing milling, smelting, or refining. We're not having to haul a copper concentrate to Asia and then import refined copper back to the US. We're actually producing refined copper right on site in Arizona, where feeding into the US domestic market. So carbon emissions are low, fresh water use is very low, energy consumption generally is just much lower. So these attributes are in the current environment are getting a lot of attention from not only from investors but also from end users of metal, as whether it's electric vehicle manufacturers or metals traders. There's a recognition that in the future companies are going to have to account for the carbon in their products, and so this copper from Florence is going to play very well or feed very well into that type of environment. So we're moving forward. As I said, we're happy with the results of the test facility that we've been operating in over the last couple of years. It's really proven out our mining method. We've produced LME grade A copper successfully. We've got two key permits that were required to transition from the test phase to the commercial phase. We received the first of those permits in December last year, which was the aquifer protection permit that was issued by the state. So we've got that in hand. We have one remaining permit outstanding, which we expect the EPA will be issuing to us in the next few months. And then with that in hand, we're ready to move into construction. It's about an 18-month construction, and that gets us in commercial scale production towards the end of 2022. On the financing side, just briefly, it is a $230 million capital requirement to build the commercial scale facility. We currently have about 200 million US of cash on our balance sheet, and that was primarily raised recently through a bond refinancing that we did back in, or I guess that was about a month ago in early February. Yeah, so we're well positioned. We've taken a big, we've got the majority of the capital requirement already in hand. And of course, with the cash flow we're generating at Gibraltar now, and with $4 copper prices, we've got a lot of options remaining to obtain the additional funds that we need. And yeah, once we build it, it's a very low, as I mentioned, a very low capex intensity copper project. Most projects of this, to produce that amount of metal are, they're going to be anywhere from 750 $1 billion of capital to be able to generate that volume of metal at that capital cost is very unique in the industry. It's a valuable asset. Yeah. So it's about a $700 million NPV on an 8% discount rate with I think that's based off a $3.10 copper price. And as you can see, that NPV scales up significantly as we, in the copper price environment that we're in today. So I mentioned at the top there that beyond, Gibraltar and Florence are really the two key assets, but we do have other projects in our pipeline, and just touch on them briefly. The Yellowhead project is an asset that we bought about 2 years ago. It's an open pitable copper deposit in central BC. It's got the potential to be a very similar operation to what we're doing at Gibraltar. And again, it's got attractive economics. Would produce 200 million pounds of copper a year in the first 5 years. So, we're quite excited about this. It does need some permitting work, and we're going to work away at that over the next 2 or 3 years, and potentially have the shovel ready when Florence is up and running. And then New Prosperity this is another asset that's in our portfolio. We're not spending a lot of capital on this one either right now. It is a major deposit. It's one of the largest copper gold porphyries in the world, but it has had permitting challenges in the past. We're in a facilitated dialogue with the province and the local First Nations to try to resolve those issues, and if we can, then it'll be a massive value appreciation here down the road. But at the current time, it's not a project that has any value reflected in our stock price today. So all in, about 15 billion pounds of copper in reserves, and we think that relative to our peers in the small and mid cap producers, that is very, it's really unmatched. When you can look at our market cap, that currently implies a value of about 4 cents a pound of copper. Just nobody else has that asset base. It's going to take us time to realize those longer term reserves, but that's what we do. That's what we work away at to try to de-risk those assets and close that gap between our market cap and the true value of our assets. So it's a significant value gap today when you look at just what we have at Gibraltar and Florence, really the two key assets. The NPV of those assets minus the bit of debt that we have on our balance sheet, still leaves a large value gap between our current market capitalization and that value. We think most of that value gap relates to the Florence project. Gibraltar is generally, it's a stable operation that we think is well understood. But, in terms of Florence, we're going to continue to work away, de-risk that project by building it or getting the final permits in the next few months, building it later this year, and going into commercial production towards the end of next year. And we think through those steps that will generate a lot of shareholder returns and value. So it's, yeah, and in the bottom chart there in the bottom right shows our growth profile in the coming years. And you know, moving from a single asset producer, about 100 million pounds roughly to our account, Florence will give us about 85% growth on the top line, but it will also significantly lower our cost per pound and increase our margins. So it's bringing Florence on very transformative for us moving forward. And then of course Yellowhead and New Prosperity, you know, down the road. So we have a strong balance sheet today. We have 200 million US of cash, as I mentioned. No significant debt maturities until 2026. You know, we have a lot of leverage to copper prices. And you could see that from our stock price movement in recent months. But you know, we believe in terms of our projects that there's a lot of runway still left in the stock, and you know, a good pipeline of high quality assets in low risk jurisdictions that we can keep moving forward. And you know, we'll continue to be an industry leader in safety and environmental performance. That's important, and you know, a top priority for us. So that's basically the story. We think that it's you know, quite a unique proposition in our view, like the combination of those factors. We did list in London just before the pandemic, actually in late 2019. Yeah, we haven't, obviously last year didn't play out the way that we expected. We were hoping to be able to spend a bit more time in the UK and be able to tell our story to investors in that market, but haven't had that. You know, hopefully after the pandemic we'll be able to travel a bit more, but in the meantime, thanks to David for hosting this event, and it's a great platform for us to be able to share our story with investors. So maybe with that, I'll hand it back to you, David, for any questions.
Great, thank you, Stuart. That was excellent, and we've had quite a few questions in. So I think we'll start with the first one, which is probably one that a lot of people are asking. Can you provide the rationale for the London listing a year ago, as you've been hopefully getting traction with the UK-based investors, but how's it been?
No, I think that's right. I think that we have been getting traction. We obviously haven't, because of the travel restrictions, haven't had as much marketing over there as we would have liked, and as much exposure as we would have liked. But when we are able to get in front of people, you know, we do think it's quite a unique story. And one of the reasons we listed in London was because we saw a bit of a gap in the market there in terms of being a small cap or mid cap producer that operates in stable jurisdictions. So we don't see many of those, and we're hopeful, you know, we hope that we can address that gap, and yeah, provide another option for investors in that market.
Yeah, and maybe extending on from that, you know, the market obviously rates you in different ways, but why do you think you know, you give the market, you know, or why does the market give you such a low valuation considering the 15 billion pounds worth of copper you have in reserves?
Yeah, that is a question that also puzzles us. I think that because we are a producer, you know, at Gibraltar, we feel that there is a lot of focus on our quarterly earnings from that mine, or quarterly EBITDA, and the market kind of forgets about the longer term portfolio that we have. It kind of gets overlooked. And so, yeah, we work away at that. We try to show that value, and, you know, try to de-risk those assets and push them forward. But I think, you know, over time, it's a patient strategy. It takes time to permit a mine and to develop and get them into production. I mean, we acquired Florence 6 years ago. So it's a long-term strategy that we have, but over time we think the way we're doing it is the best way to create value in mining, is through a patient approach.
Okay, and Alan asks, would Taseko consider hedging production at the current copper prices to lock in strong cash flows?
Yeah, it's certainly something we're thinking about. I think our approach to this point has been, over the years, to buy put options. So we buy copper put options out of the money, and that gives us downside protection. So that's a strategy we've had in place for 10 years at least. It's served us well. It provides protection against short-term volatility. Like even last March, for example, when copper prices dropped below 220 a pound, we had some put options in place. They paid out. So we treat it a bit like insurance. So that's been our approach to hedging. We haven't, to this point, locked in prices. We feel it's also important to keep the upside in the copper price open for shareholders. So that's a priority as well.
Okay. And Mike asks, doesn't the in situ leaching run the risk of polluting the water table?
Yeah, it's a good question. I mean, that is kind of the key, one of the key risks one of the key reasons we had to show the regulators that we could run this test facility properly for 2 years. We have a very, as I said, a very unique situation of Florence, where we have also natural boundaries above and below the mining area. So above the ore body, we have a 40-foot thick impermeable clay layer. And below the ore body, we have a sulfide bedrock, which is also impermeable. So we have natural boundaries above or below, and we control the horizontal flow of solutions through hydraulic pressure applied through the wells. So and we can do that, and we ran the test successfully with 22 production wells in operation. We ran them for about 18 months, and proved to the regulators that we could do that and maintain hydraulic control the solutions within the ore body. So with that in hand, yeah, we're ready to move forward and increase expand the well field.
Okay, and Irvin Hunter says, and I think he's worried about getting back to playing golf here. He says, when the copper extraction is completed, is there any danger of the golf course developing sinkholes?
Yeah, we have very little. There'll be there won't be any subsidence here. We're not fracking. Mother Nature has already done the fracking for us, and we're removing very little material from underground. The copper grade here is 0.36% copper, so there's very little material being removed from the ground, and none of those kind of issues. We won't have any of those kind of issues at Florence.
John Shevlin says, and many of our audience will use Stockopedia, by the way. So Stockopedia apparently suggests Taseko has $277 million of Canadian debt. Is that accurate?
No, I mean, that would have been accurate a few months ago, but what happened at the end of January and early February, we completed a bond refinancing, and we refinanced our $250 million bond, that's US dollars, and we actually upsized that to 400 million. So we have 400 million US of debt, and the reason that we raised that additional debt was to provide capital for Florence financing. So the balance sheet today is essentially 200 million US of cash and 400 million US of debt.
Okay. And Rob asks, why list in the UK as opposed to the US?
Well, we're listed in New York and Toronto as well. So we've been well established, I think, in North American capital markets. We're well known, I think, on this side of the ocean, but certainly the opportunity to move to also list in the UK market, as I talked about earlier, was one that we thought was a good thing to do. So yeah.
And here's a current one. Do you expect the new Biden administration will have any impact on your permitting process?
Yeah, that's a question we get quite a lot, but we don't see any change in the environmental regulators. We have a good dialogue with the EPA that's continued, and we're in the final stages, the final innings of the permitting process. And in fact, the prospect here of producing low carbon copper from a U.S. Domestic source, it actually fits very well into the Biden kind of narrative about securing your supply chain of metals and investments in renewable energy infrastructure and electric vehicle manufacturing, right? All those things require copper. So, and we can do that and produce that in the U.S. and not have the product import, and that domestic supply of product can displace imports that are currently coming from South America or Asia. So, yeah, we think it's perfectly timed, and yeah, we don't see any significant risks on the permitting side.
Great. Okay, well, thank you, Stuart. We've got a couple of questions more, but I'm sure you can answer those over the next 2 days. We'll get them onto our website, but that's fantastic. You've given us a good review of Taseko, and I'm sure everybody's learned quite a lot there. Thank you.
Yeah, great. Okay, thanks very much, David. Thanks, everybody.
Thank you.
Yep.
Okay, now we've got our first fund group team, a team situation, a new team, in fact. Hello, George, and is Mark with you as well?
Mark should be on. Hello, David.
Hello. There's Mark. Excellent.
Yep.
Hello, Mark.
Hello, David.
You've probably already heard a few companies, and you're going to tell us a fund approach now, of course, a new fund at Amati, which is good. We know Amati quite well. They've been to many of our Mello events. And I'm sure both of you will tell us what you're going to achieve, hopefully, and how it's going to fit in well with Amati.
Thanks, David, and thank you for the opportunity. It is different to the companies. I'm going to share my screen here. Okay. Can you all see that okay? Coming through, David?
No, I've still got Taseko for some reason.
Okay.
I think he'll have to change it. He'll cancel his.
Yes, I'm sharing the screen.
He needs to stop sharing it.
Are you taking yours off, Stuart?
Hello, David. This is Edmund here. I can see the Amati Fund presentation on the screen.
Great. Okay. Good.
Okay. Excellent. I know we don't have much time, so let me just, without further ado, I'm just trying to, no, because I think I did it twice. Thank you again, and we are, as David said, we're very new. We actually launched yesterday. We're on various platforms. What I wanted to take you through quickly today is just, it's called Amati Strategic Metals Fund. Amati, as David alluded to, is well known to the audience, the specialist investment boutique, very successful in specialist boutique, where the majority of the staff own own the business, and the managers' interests are aligned with the clients. And they have very experienced investment teams. Now, I think a lot of people on this call tonight don't know Mark and I, but we have been around for a very long time. We've been lead advisors to 3 resource funds in Germany that have been extremely successful. And although we've been based in the UK, it's given us a chance now to create what we think is very much a unique product. So you've been hearing from the companies tonight, and what we provide the clients is with a longer term active exposure to the metals sector, which can be quite dynamic and can be quite volatile. And looking at putting a very actively managed portfolio, looking at the best companies right across the sphere for what we determine to be strategic metals. Now, what gives us, we believe, the edge is that we have many years of actual operational experience working for the mining companies, and also having experience in the financial markets. We've been on the sell side, we've been on the buy side, and we've been operating on a global stage. So this fund actually gives UK investors an opportunity to get exposure not only to different metals, which we deem to be strategic, but also to different jurisdictions around the world.
Hello,
So
George. Sorry, this is Edmund here. Would it be possible for you to put your screen back on widescreen so we can see full screen, so we can see the whole presentation? We're getting a lot of people begging you to make it a bit bigger so they can see what's going on. Okay, I'm going to. I did share the initial one. Let me just share the actual presentation that I have open. The PowerPoint slideshow presentation. So can you see it now? Fantastic, thank you. Okay, that's the one I was trying to, and I think because we were both, there was a previous speaker getting his presentation on there as well. So this is Amati, for those who don't know. At the moment, over £1 billion under management, and this is the new fund. It hasn't even shown up on this pie chart yet because, as we said, we only launched yesterday. This is myself and Mark Smith. You can read this in your own time, but myself, 27 years experience, and Mark Smith into his 19th year experience. And what we actually do is we do a lot of due diligence on these companies. So the companies that you see on your panel today, we know these companies well. We know other companies around the world, and we really look at a tight portfolio and select what we believe is the best of the best. We see a great strategy, it's a great add-on to Amati with a smaller companies team, because we think alike. The investment methodology is very similar. It's a bottoms-up, real value investor in metals and mining, and we've got an opportunity now to really share macro and thematic theme discussions with Amati, and all the analysis is shared with the Amati team on the Connect system. Now, John at the beginning spoke about, and I don't want to go through what you're saying there, but it is what we believe, what John was saying, that the next 10 years could be a very exciting period for metals in general because of the transition from fossil fuels to sustainable energy. John spoke about rising debt and political uncertainty and inflation. These all come into it. That's why in the mix we've got gold, we've got silver, and it's really for us looking at the supply demand fundamentals of each metal, and we're also looking at the changes in technology. As I think John held up a battery a couple of times, and if you look at the EV, the battery technology for electric vehicles, that's constantly evolving, and to the detriment of some metals and to the advantage
other metals. So these are all quite exciting developments that we monitoring very closely, and we're adapting the portfolio accordingly. Why it's quite interesting. You can say, well, we like copper and we're going to invest in it. But if you, this snapshot, it's quite busy, but it shows that over just the 10-year snapshot, which we show here, is the performance year on year of copper, nickel, zinc, gold, platinum, and silver. And you can see 1 year copper's the winner, or gold's the winner, or nickel's the winner. And really what we're trying to do with the fund is look at the bottom up in valuations and move the fund around where we feel that some sectors have got too expensive on the valuation. I think you heard about Caledonia talking the same way, where even the CEO of the company says, well, my company was too expensive, and there was a correction. So we've got the opportunity to then take profits on that and look at other companies that are just too cheaply valued in this market. So we're kind of looking at a fund that will invest across precious metals, industrial, and specialty metals. And these are just a little simplified donuts of how we see through the cycle we would be monitoring. And we've got a lot of experience in looking at that and saying, okay, this is the time for being a little bit overweight precious metals, then into industrial metals, and then obviously what's happening with the specialty metals in the background, which we're taking advantage of. I won't spend too much because we don't have time here, but this is one of the slides where we're looking at on the left-hand side, you're looking at the Goldman Sachs commodities index over the Dow Jones Industrial Average from 1900 until 2000. And you can see, okay, the commodities index is a broader commodity index. It includes oil, it includes lumber, some of the soft commodities, agricultural commodities. But you can see there are times to be overweight in the commodities sector, and there's times to be underweight. We've come out of a 20, 30-year slump of commodities relative to the broader index, and we're starting to creep out of that. And this is quite exciting for us. Look forward for the next 10 years. Inflation is a big theme, and I've mentioned that a couple of times. And you look at the high excessive money printing here represented by M2 money supply, and this goes back to 1971. So you can see what's happened through the past 18 months to 2 years. There's been excessive money printing, and there's usually a lag with inflation. Then you've got higher commodity prices as well. That's why we particularly, right at this junction, we like precious metals, but it's going to be a short term, we think maybe 2 or 3 years, and then really it kicks in for the other metals. So I'm going to hand over to Mark here just to talk about some of the other metals as well. You're on mute, Mark.
Thank you, George, and thanks for David for hosting us. What I want to reiterate really is what John opened up at the beginning of this this forum about the demand that the green wave, quote unquote, will create in the metals and mining industry. And this slide here, it just encapsulates the need that we've all read about in the press for a reduction in global temperatures. 1.5 degrees is the agreement that the Paris Accord came up with. Now, to achieve that temperature reduction, we're going to have a significant reduction in CO2 emissions. And what that means is we're going to have to change the energy mix of how we energize the planet. And what that means is less fossil fuels over the next 30, 40 years, and more renewable energy. Renewable energy will require metals. Solar panels need copper and silver. Wind turbines, 1.5 megawatts of a wind turbine is a ton of contained copper, notwithstanding the actual infrastructure of putting those turbines on land or at sea. Electric vehicles are going to need metal as John was saying, to give you some numbers, I think Elon Musk sold 500,000 EVs last year. His ambition, and I wouldn't bet against him, is to sell 20 million units by 2030. I don't know the exact trend of how our metal markets will supply or will react to the demand through supply adjustments, but to give you an example of the metals that will be needed, if Elon is correct with his market penetration of electric vehicles, you're going to need 94% of current graphite production just to meet his battery demand, 31% of nickel, 165% of current lithium supply to meet his own demands, let alone what VW and the rest and Ford come up with. Copper, 10% just for wiring up the electric cars. So there's going to be a big demand coming for metals. Next slide, George. So this chart here really highlights some of the questions that the audience posed to John's presentation of where's the metal going to come from. And generally what you see is academically, there could be a shortage of supply. In reality, the market never goes into deficit. It physically can't. But what happens is new supply comes on, but it's brought on stream by higher prices. And what we're seeing at the moment is the initial wave of that supply response, and we're getting higher metal prices. One rule of thumb that I adopt is you own stuff that China doesn't. One of the prime metals that China's always busily importing is copper, because it doesn't have sufficient of that to meet its own domestic demand, let alone exporting finished product. The other metals that we see are important are nickel, lithium, cobalt, graphite, aluminium, vanadium for fixed storage batteries. And the unique thing about this new fund is we're flexible enough that we can invest in these metals at different times of the cycle. These metals will peak and trough through the different metal cycles, and that will have a material impact on the valuation of the equities that produce these commodities. Nuclear as well, we're going to have to use nuclear power to support the renewable energy. Renewable energy, you can't turn on and turn off without fixed storage batteries. So you need a base load of power. And what's going to happen is the coal, the oil, the natural gas, fossil fuel element of the energy curve will diminish. That will be replaced by nuclear and renewables. So this fund as well as looking at the green metals for energy supply, will also look at uranium in this fund. Probably not more than 10%, but we see some great investment opportunities in this sector as well. Next slide, George. One thing that we're quite excited about is, as George said, we've got a history of being in mining and geology. My background's an exploration geologist, worked in Africa for 5 years before going into the investment banking world and remaining there for the next 18 years. But what we can do with this fund is we can apply both our industry experience, but also our financial knowledge and skills in financial modeling of these companies. But we understand the company behind the numbers as well. And to give you a flavor of how we approach things, on the next slide, this is a company based in Papua New Guinea. And what we saw as an opportunity here, so this is where we put our geological hats on and our mining hard hats and look at the asset itself, notwithstanding financially modeling this company out. But in 2017, this company was starting a mine in Papua New Guinea that it acquired from Barrick Gold. Barrick Gold were successful in getting access to this mine because of their CSR program that Caledonia was talking about, how important that is. They couldn't get access to the mine because they didn't have the correct CSR program in place, and the locals created a little bit of unrest. This new company came in with more of a focus on CSR and managed to get into this mine. And there were 3 ore bodies there which were contained in what's called a low sulfidation epithermal system. What that means is gold is contained in quartz veins. Now, these quartz veins never occur in isolation. So we looked at this and said, okay, there's 3 deposits. Geologically, this should be 1 deposit. And what piqued our interest was a single borehole that was drilled and forgotten about with the previous owners. So we invested in this company, and it was 70 million Canadian dollars when we invested. They then started to drill out their ore body. And what you can see here in two years on is that ore body starting to grow. Fast forward to 2020, and actually that ore body is 1 ore body, not 4 separate ore bodies. What that meant was that this resource went from 1 million ounces at 14 grams a ton gold to over 5 million ounces at 14 grams a ton gold. And this mine expanded from 200,000 tons a year to now putting in a plan to mine at 1 million tons a year. Just to give you an idea on the value curve of these sort of assets that we can equally pick out in many different commodities and jurisdictions, this went from 70 million to $1.8 billion in value over 3 years. And we invested in this company and still do for further upside. Just
David,
enough.
I'm not too sure about the time that we have left. Maybe we'll go to the last slide, Mark.
Yeah.
You can have another 2 minutes, don't worry.
Okay. Maybe you just want to go through the process, and then I'll wrap up on the next one.
Yeah, so as we mentioned, we're technically driven fund managers, and we have both a top-down view on the assets from the metal markets and the inputs for metal cycles and prices, but also we have a bottom-up approach. So we build all our own financial models. We go out on site when we could pre-COVID, and we go to the mines, gather data on their cost base and their production criteria, and also look for expansion opportunities within their asset, which the market's not aware of or not paying for. And that's where we can see a lot of value driven through the drill bit going forward.
So just to wrap it up, this David, is what the fund's about, looking at the split of the assets, geographic split, the number of holdings. It's tightly held at 35 to 45 companies maximum. No one asset class more than 70%. We are geographically diverse portfolio, and really we're talking companies in the range of 100 million market cap to 10 billion, with an average weighted average market cap around 2.9 billion. So I'll leave it there, and I'll be on the panel at 9 o'clock, and maybe we can explore some other questions there as well. So.
Great, thank you both of you. And yes, you are on the panel later, Judge. So we've got a few questions, but we can always put those into the session then. That'd be great. Thank you both. Great. Well, now next we got Condor Gold. Hopefully, we should be able to bring in Mark from over in El Salvador. Ah, there you are, Mark. Yeah. Excellent.
Hello there. Hi.
Yeah. How did it go? You've got everything all boosted in your hotel room?
Yes, I have. I'm just here en route to Nicaragua. I fly there early tomorrow morning, and we've managed to get a new router in the room. So hopefully this works for the viewers. Brilliant.
Well, yeah, it's coming through loud and clear here. And you've had some big news yesterday, so I'm sure you're going to start us all off with that, I guess.
Yes, I could do it. I could do it the introduction, certainly.
Anyway, over to you with Condor Gold. Great.
Okay, I'll go on to share screen. So just give me a moment. David, can you just confirm to me that you can see the screen?
Yeah, I can see the screen, but it's blank at the moment.
Oh. Can you see it moving now?
No.
Okay, I'll stop sharing and I'll try it again.
Okay. Yeah, there you go. That's good.
That's good. Okay. Okay. So I'll go straight into the presentation, everybody. Yes, just a preamble. So I've been with Condor Gold for 10 years full time and involved with the company for 14. The news we had yesterday is that we have bought a brand new SAG mill from First Majestic Silver, and that's cost us $6.5 million. And we've issued them $3 million of that payment is by issuing shares in Condor at 50p, which is a 10% premium to the market at the time. And the balance we're paying in cash over the next 3 to 4 months. The good news on it is it's bought from Metso, who are the leading mill manufacturer in the world. They're based in Finland. They provide about 50% of the crushing and grinding equipment to the global mining industry. And it comes with warranties and so forth. And it's a complete mill package. The mill's pretty big. It's 24 foot in diameter. You can imagine a big tumble dryer, 24 foot across, and 18.5 feet long. And with the existing motor that comes with it, it can do 2,300 tons a day. And if we put a bigger motor in, it can actually go do 2,850 tons a day. To put that into tons per annum, which is the previous speaker was talking about, we're 0.8 million tons a year with the installed capacity, and 1 million tons a year if we buy a bigger motor and upgrade it and that involves more power, which is the bottleneck. It goes from 3.3 megawatts to 4.1 megawatts. The mill is 90% ready to be shipped, and some of the component parts already in Mexico with First Majestic Silver, and we have to move those off site in 30 days. So it'll start to come bits and parts of the mill. There's 32 items that we're buying or start to, I hope, come into Nicaragua ports within the next 6 weeks. But it'll take a few months to get everything in because some of it's in Europe and more tricky to ship. So that's what David was talking about. That's a real game changer for us. It puts a real line in the sand about production sizing the mill. And so that we've got a couple of production sizes of that existing mill, and we're looking to materially increase that. So that's a real good news. And I'm being Nicaragua sorting out shipping, logistics, and I'm going up to site for a number of days because we've got 3 drill rigs operating right now. So the strategy here, I slightly changed the slide here. We've said this particular mill was an opportunity, if you like. We can do 80 to 100,000, but I'm fairly confident we can do 100,000 ounces with this as our base case. The reason for buying the mill is that it cuts our lead time for that particular item by 12 months. So if you want to buy a mill today from Metso, who are the Mercedes, if you like, of the mill manufacturing market, it is probably 3 to 4 months to do a bespoke design for a mill. Then it's a 40 to 45 week lead time, and then there's 2 months to ship it. So that's a 12-month period, and we're reducing that completely, that time, because it's already off the shelf. And First Majestic, it's up to them to explain why they didn't want it, but they ordered it, they paid for half of it, and we've effectively stood in their shoes and get all the guarantees and paid them the money on the mill. So it's terribly significant news for us as a project. So the twin approach is to build the mine out on that mill, and we're going to do the FS studies and further engineering studies around that in terms of sizing belts and gold rooms and cyclones and tanks and the rest of it, and then to show a path to 5 million ounces of gold. And the project and the previous speakers is a low sulfur degradation epithermal vein system. That's exactly what we've got, surprisingly. And these systems can be very, very big. This system was last mined 73 years ago. and the mine closed because one of the underground parts flooded of the historic mine by Noranda. But our investment highlights, well, we're going to production. We've been saying that for 5 years. It'd be no surprise to anyone. We're fully permitted on 3 open pits, which I'll come on to for 1.12 million ounces. That's a mineral resource, both indicated and inferred. It's 85% indicated. Develop this mine, materially expand it. We've got 1.2 million ounces of underground that's not permitted yet. We easily get 50, 60,000 ounces out of that. We've got a district play of 5 million ounces. We're $30 an ounce in the ground. We've got lower 690 all-in sustaining cash costs. That's your kind of break even. At the end of Feb, we had 11 million in cash. And the cash component of this acquisition is $3.5 million, fairly undervalued. And we got 2.4 million ounces. Half is indicated and half's inferred, half's open pitable, half's underground. Nicaragua, gold's their biggest export. It's been, you get concessions for 25 years. It's a good address to be operating in, and they permitted a mine, so they wanted to go ahead. And it's a big country. Here's your low sulfidation epithermal vein system. So the 2.4 million ounces is made up of 7 different deposits. All can be expanded along strike and down depth. And the core of it, you can see my mouse there, is around La India, America, Mestiza. There's 2.1 million here. And just by drilling down those ore shoots, we can add another 900,000 ounces on. We're drilling over in Cacao at the moment and in the main pit, and I'll come on to that in a minute. Here's La India vein. You're looking at 1.2 kilometers long. This is the vein is caused by a fault in the ground, and this is the plate tectonics in this part of the world, Central America, with the Pacific plate subducting under the cocoa plate, and it causes a major regional fault, and up through that come up gold-bearing fluids. And so you're looking at a couple of $1 billion in situ metal there, and the top 900,000 ounces is open pitable, and about 820 is indicated and about inferred, and it's the indicated you put into an economic reserve, which we did about 6 years ago. And we've got this fully permitted to extract, and there's a 10-to-1 strip ratio on this. And we're currently drilling, if you can see my mouse, where L is on La India. We've got 2 rigs there. I've just been on the phone for an hour and 10 minutes this morning to Nicaragua, and we've completed drilling in the northern starter pit. Here's some of the drill intercepts. We got 10 meters at over an ounce, our best one in the pit, and there's over 40,000 meters of drilling in the main La India pit. That's a cross section of the pit. Here's the permitted mine site infrastructure. So this magenta area here, this outline, is everything within that's permitted. So there's the processing plant. There's the main pit I just showed you the photo of La India open pit. This little green one we finished drilling at about 24, 25 drill holes in this we've completed, and we're drilling. We've only got about 7 left in the southern pit at the moment. And here's a waste dump. And you haul 1.2 kilometers to the mill. We've got a tailing storage facility here. That's now 72% engineered, fully engineered to FS level. And here we've got 2 high-grade pits to the north, very centrally located. This is a kilometers grid. And underneath it, we've got another 1 million ounces underneath these 3 pits. So that's de facto permitted for me, because they'll easily permit a portal in the side of a hill if they're going to permit a pit 1.2 kilometers long and 400 meters wide. This is putting us in context of grade and all-in sustaining cash costs. So if you look to the left-hand chart, it's got the grade. So these are the Canadian companies, predominantly our peer group comparison. Who's got the higher grade over pits, over 1 million ounces of gold in them? Well, Condor's got one of the highest, the second highest on this this analysis. And we've got lower quartile break-even or 690 all-in sustaining cash costs. So a very attractive proposition put in there by a Canadian friend of mine. So the purchase of the mill, I've touched on a number of these bullet points here. And importantly, it's 90% ready to be shipped. And I'm also delighted that First Majestic Silver, which will shortly be a $4 billion company, have done their due diligence on Condor and given us a vote of confidence, both the management team and the fact there's going to be a mine here. And they know the mill, obviously, because they've ordered it, that we're actually going to put in here. So they've taken $3 million in paper, which is fantastic news, at a small premium. Delighted with that. And this will be form very much stage one of what we're looking to do going forward. This gets us going and it cuts our lead time by 12 months for this particular item. And I mentioned with a bigger motor, we can get that production up 22%. I'm now just going to talk about the permitted mill feed. I'm sorry if this is a bit technical for some of your viewers, but when you've got a mineral resource, say of 1 million ounces, you can't get it all out. You're blowing it up and you're taking it, and some of it's uneconomic. And so that number I gave you of 1.12 million ounces, how does that look if you take that rock out of the ground to the processing plant? And the answer to that is you actually don't get 1.12 million ounces, you get 847,000 ounces of mill feed. That's what it's called. And so in total, we have 8.5 million tons at 3.1 grams. Bear in mind, a gram is $60. A gram of gold is roughly $60. So 3 grams is $180. We talk about grams per ton. So a ton of rock is worth $180. And to turn that ton of rock into bar of gold, you've got the mining costs, you've got the processing costs and the G&A typically. In our case, they're about $55 to $60 a ton, and the ton in situ has got $180 of gold in it. So that cross-checks with your low all-in sustaining cash cost of $690. So these are all fully diluted models done by SRK Consulting in Cardiff, they're not ours. Although some of those internal studies which they supported and bagged. And this supports the mill feed that we're doing with a new plant and underground. Just conscious of time. We've done a high-grade scenario, so we can, not only do we have that big production feed of 1 million tons a year for 8 and a bit years, that 8.5 million tons, we could also high grade it. So what of course you do as a businessman, you'd say, right, well, we're going to put the highest grade rock through early on to pay back our loans and have a project payback and increase our NPV and get lots of cash flow early. So we did these studies, which we previously announced, and you can see in aggregate these, and this is with dilution skins, it's fully diluted to the mill feed. So that's what turns up at the plant. That's why we've been doing these studies in the background to getting permitted. We've got 1.6 million tons of that 8.5 million is super high grade. It's 50% higher grade at 4.6 grams. So there's 245,000 ounces. I'm going to caveat this by saying we still need to do infill drilling on this. Now we're doing 4,000 meters of infill drilling on the main pit in the starter pits of Landia. This is this one here, 387,000 at 4.2 grams. We're doing infill drilling there to 25 meters spacing. So that can show negative surprises and it can show positive surprises. But of course, we're going to get it to tighter drill spacing to increase that confidence ahead of mining. And 25 meters drill spacing is measured to the highest category. And then we grade control after that as we go down. So you're going to mine down 7 to 8 meters per bench, and you're going to do grade control drilling to test where the high grade ore is within it. So what I wanted to show people on this slide is we've got 1.64 million tons at 4.65 grams, 245,000 ounces, 225,000 ounces of recovered gold from the 3 starter pits. Fully permitted this. We're permitted construction operator mine for 10 years. And what happens if we, through our new mill, 2,300 tons a day at the bottom, if I just say, I'm going to be conservative, let me put 4 grams, let me assume it's 4 gram material, so it's my 0.8 million tons a year, times 4 grams, divided by 31.106, which is the number of grams of an ounce of gold, 91% metallurgical recovery. In fact, I think that'll go up to 93, 94, as that is with Calibers Mine. That gives you 94,000 ounces of gold if we, in the first couple of years, if you were to put this high grade through, which would be our intention to maximize economics. If we increase the motor size and with the same bit of equipment, process a bit 22% more, or 1 million tons of rock a year at the same grade, and again, I've been conservative here compared with the high grade scenario, we get 117,000. Now, all this is going to be subject to further infill drilling and further geotechnical work and further hydrology work, and all those studies just ahead of mining. As we build the mill, we'll be drilling. There's more work to be done to increase this economic certainty, but this just gives a high level indication of where we are on those numbers. Here's the main pit of Landia. In the north, we've completed the drilling here. We had a drill result out last week of 9.6 meters true width at 4 grams, 3.98 grams, of which about 3 meters of that was colluvium at 1.5 grams, and that's detailed within the press release. And we've got the 2 drill rigs operating here. We've actually done virtually half of these now. The orange ones are meant to be drilled. I haven't had time to update this. And we've got 7 holes left within the southern starter pit. And that's your 60,000. Assuming that infill drilling comes back at 25 meters, like Swiss cheese anyway, assuming that comes back, we have 60,000 meters on, within 35 meters of the 6,000 ounces, sorry, at about 4.2 grams within 35 meters of the surface. So it's just lying there waiting for us to take that out to the mill, either to our mill or we can possibly toll mill that. Here's the plant we're clearing. Just in terms of time, I'll go on. So we're halfway through clearing this. I'm looking forward to seeing it this week or next week. As we've got all that land and we're doing the site preparation. This is the second part of the strategy, which I'll go through quickly. This is drilling down the ore shoots and get another 900,000 ounces. This is just showing you underneath the ore shoot, this is a long section, sort of side on at the vein, and you've got 190 meters here. And this is all open. You've got drilling intercepts of a third of an ounce, 6 meters at 10 grams, the 60 meters at 10 grams here, just to show that we can add ounces. This is the fully permitted area, which I've shown you before. Now it's in navy blue. And 4 kilometers away, we're drilling on cacao. We think there's another 500,000 ounces on cacao. So as of this morning, we've drilled 1,191 meters on cacao. So we're 20% through the drill program. So the team's doing a great job there at the moment. And the objective of that drill program is to define that 3 to 4 kilometer strike length, which I'll show you now. So we've got here 60,000 ounces of gold. We've got a major regional fault running through here. We've got good rock chips here with some more formal artisanal mines at 11 grams and more over here at 15 grams. So is this the next Landia vein? The geologists tell me this is. The vein itself looks as healthy and as wide as any vein at the main Landia vein, any part of the vein at the main Landia vein. So let's hope they're right, and I'm backing that decision, and so is the board, to put in this 5,000 meters to sort of test it. And we'll be doing some big step out drillings to see if we can hit it along strike. This is just showing the project. We've got two calderas, sorry, to the south and north of the project, and a major regional fault running through it. In fact, 2, which I'll show you next. So the 5 million ounce district potential, we've been working on this quietly in the background for a number of years. There's 2 major regional faults, Landia Corridor and the Andrea Corridor. These have a linking structure, and there's a highway fault here. And this is how you look for district plays. You do all the soil geochemistry, airborne physics, airborne geophysics, a structural geological model, detailed geological mapping. And we've kind of done all that over the last 5 years, as I say. And there's some great targets that we've got here. So what are we up to now? We've got 75 employees. We've got 95% of the land. We'll get the rest of it. We're working with the government to help us get the rest of it. We're doing more engineering. We're about 72% as of yesterday engineered to an FS level on the main tailings storage facility. This is about $1 million studies. We've done all the geotechnical drilling for 23 holes. We're doing site-wide water balance. We're halfway through that, and water management system with SRK in Cardiff. We're in fact just doing a hydraulic study, which we signed off on to agree them to do yesterday. And we're doing all these, we're completely de-risking the project and getting it ready, shovel ready, basically. And the short-term objectives for us to buy the balance of the land and complete the drilling on the pits, the starter pits within Landia pit, do the drilling on cacao. We'll do some infill drilling on Mestiza. That high-grade pit has 110,000, 120,000 ounces at 8.6 grams, but it's 30% indicated, 70% inferred, and we need to take that up to the higher level of confidence in infill drill and put a reserve around it. The important new SAG mill, which we've got to get our skates on to sort it out, the logistics, which I'm working on, an advanced engineering project, and so the site preparation gets completed. Environmental and social, we take this incredibly seriously because there's a community near the mine. It isn't a former mining community. We spend $20,000 a month in that community. And we have lots of different engagement programs, which I could talk for hours on, but don't have the time. What we're doing at the moment, we've imported from Israel a drinking water container. It's within a container, but it's a water purification plant, so what I'm looking for. And that can provide 2 litres of water per second. That'll basically provide the community. So we're doubling the amount of water that we're gifting to the community. There's no drinking water or sewage up here, so it's quite a poor part of town. But that's a big flagship community project for us and an enabler. We're very pleased with that. So to summarize on the investment case, we're going to go for the 100,000, 80 to 100,000, but I think we'll be near 100,000 on the production with the mill we just bought. We'll look to materially expand that in due course by adding it underground. We're going for the district. We've got 3 rigs on. One at the moment is on cacao, but we might just put another one on there at some stage, or expand that drilling if it comes back nicely. We've got low all-in sustaining cash costs, $690 an ounce, and most importantly, we're fully permitted, and we're really cheap at $30 an ounce in the ground. In terms of share capital structure, this is a chart. Jim Mellon has got 18%. Jim and myself have got over 20%, which is good. The board has got a lot of skin in the game to make this work, and we're reasonably. There's about 40% reasonably tightly held here, and that concludes my presentation.
Excellent, thank you, Mark. What we now want to do is maybe ask a couple of the questions from the audience, and Peter here asks, well, you've clearly spent 6.5 million on a mill, but can you estimate the remaining capex spend required to construct the mine and get to first gold pour, and the timescales maybe for this?
Yeah, that's a great question. It's an obvious question. The pre-feasibility study that we did was on exactly the same size. It came up, recommended by Lycopodium, on 2,300 tonnes a day. We bought one for 2,300 tonnes a day. That was just on Landy open pit. We've now got 3 pits permitted, so that's why we can make it bigger. The capex within that was $106 million, but we had to buy all the land, and we had to do engineering studies, and we had to resettle a village. This time around, we're not doing it. We're mainly through the engineering studies, and we bought all the land, or most of it, and we don't have to resettle a village. So that's the best benchmark I could give. Now that we've actually got the mill, we are talking with Metso Outotec, and we will be talking with our equipment suppliers on actual final costs to purchase the balance of the equipment. And I don't want to put a number out there until I've actually got some numbers back to me. But we've only just announced this yesterday, as you'll appreciate, David. So I can't give a definitive number. We can either get brand new equipment again on everything, or we can try and do it a little bit cheaper and get secondhand primary crusher and some other secondhand equipment as we're going on. We've got to work through that process. But I'd hope that over the next few months we will come out with a definitive capex number. In terms of the lead time, the second part, once all equipment is into the country, all equipment for the mill, then I would expect a 12-month construction period.
Great. And Kieran asks, when are you expecting to deliver the initial production levels of 80,000 to 100,000 ounces?
Year 1.
Year 1, great.
Maybe, hopefully, yeah, exactly, year 1.
Yeah, and he also asks, will you need to raise additional capital to support this future business activity?
Yes, we will. We'll have to raise the construction finance at some juncture, and the construction finance will be a combination of bank debt and gold loans and equity. Great.
And Condor has 3 drill rigs on site. What are the objectives of the drill program?
Yeah, 2 drill rigs are within the starter pits at Landy main pit, and I highlighted the 2 starter pits that we're drilling there. And that's to drill onto 25-meter spacing. That increases the confidence of the geological model, increases the knowledge base, and that takes it to a measured resource. So that's the final drilling you do ahead of extraction. So 4,000 meters with 2 rigs is doing that, and it's replacing some RC drilling, which was done, some of that in the pits and some of the bit between the pits, to give a higher degree of confidence. So that's the objective of that program. The second program of 5,000 meters with the Cacao, which I mentioned we've just drilled 1,200 meters of, is to test a strike length of 3 kilometers. We've only drilled 500 meters before and have 60,000 ounces and 20 of that's open pit. But we want to see whether it's not 500, but 3 to 4 kilometers long. So we're testing the structure with that. It's not meant to give us a resource update, but we think it's got a 5 million ounce potential. So the pyramid of gold producers, the closer you get to be have say 5 million ounces of gold in the ground, as opposed to the current 2.4 we've got, the more valuable they are, because they're very scarce to get that scale of gold deposit out globally. So those are the 2 drill programs that we've currently announced.
Great, excellent. Thank you, Mark. That rounds it up, and thank you for giving us a good overview, and certainly the interesting news that came out yesterday. That was very timely ahead of the event. It was excellent. Thank you.
No, it's great to have the event to actually talk about it. So
yes, it's nice
after announcing it.
Brilliant. And maybe come back in a few months' time to see how it's all going. Yeah.
Yes, I'd love to do that.
Thank you.
Thank you. I'll stop sharing.
Thank you. Great. Well, Edmund, here we go.
Hello, David. How are you?
Yeah, it's good to have you on board. I need somebody who knows what they're talking about. I'm a little bit, shall we say, naive in some of these distant projects.
And when are you getting that person on then to talk?
Yeah, very good.
Okay, all right. Enough of the pleasantries. I got 9 minutes maybe.
Yeah.
So I'm going to keep it quite short. The idea here today was to give a very short little presentation, not really a presentation, a little chat, linking ESG to commodities, because the two seem like a paradox. How can the two go together? That's really the question I'm going to try to answer in the next 8.5 minutes now. So, at the risk of turning the audience off, remember, I just want to remind you what ESG is. E for environmental, I think we all get that. Renewable energy, reducing pollution, combating climate change. I think everyone understands that. The S, though, is also very important. These are the social impacts. The social impacts, as we've heard a lot about local communities, if we're thinking about mining companies, for instance, how they engage with the local communities, how they help the local communities, maybe employ them, and also how they provide facilities for the local communities, whether it be, as we've heard, clean drinking water, hospitals. We've heard a lot about COVID, providing, for instance, COVID vaccinations for the local workers and their families. All of this comes under the S for social. And then, of course, you have the governance, which is, let's be blunt, a lot of governance is about not ripping off the shareholder. Okay, it's making sure there is robust corporate governance so that the directors do their job and make sure that the company is run in the interests of the shareholders. So all of these 3 things are very important. Now, if you take the fact that ESG as a strategy has become super popular, everyone suddenly wants to invest in these ESG funds because they all want to be doing good with their money, let's say. It's nice to align your ethics with your investment as long as it doesn't cost you too much money. And the argument is, so far, it doesn't. Now, if you were to take the first simple approach, what I call ESG Mark 1, version 1 is all about excluding bad companies. So in other words, I'm going to buy, let's say, ESG fund, and under this version 1 of the fund will just look at the universe of companies that it could invest in, let's say, whether it be the Stocks Europe or the MSCI World, and then we'll just chuck out all of the companies that it believes are not good enough in terms of the ESG characteristics. So what you do is you have a nice big database, you score each company on some E criteria, some S criteria, some G criteria, you get a number at the end of it, and if that number's too low, out goes the company, you can't touch it. It goes on the barge pole list. And then what you have is a reduced universe of companies in which you can invest because they meet the minimum the minimum barrier, the minimum entry requirement in terms of these ESG criteria overall. So this is what we call an exclusion methodology. And that basically is binary. You either are a good company, you're good enough in ESG terms, or you're a bad company. You're not good enough and you get excluded and you cannot be invested in. I think that's a bit simplistic, to be blunt. And if you look at a lot of the ESG indices today, or the SRI indices, socially responsible investing, pretty much the same thing, you end up with companies, you end up with a fund that is very overweighted in things like technology. Now, if I'm Microsoft, it's quite easy to be ESG friendly in a way, because I'm not a mining company. I don't create lots of pollution. I can try to be nice to my employees, because by the way, I pay each of my employees on average quite a lot of money. So it's quite easy also to give good benefit, to make sure you promote diversity at work and do all the right things. And also to be quite cynical. A company like Microsoft will also employ an investor relations person who will also be very good at marketing ESG credentials of Microsoft to make sure it gets the highest weighting possible in all of these ESG funds. So you end up, if you buy an ESG fund today, often having by nature a very heavy overweight in technology. Now, commodities don't sound like something should be in an ESG fund, right? Because they create pollution, you're digging big holes in the ground, you're using a lot of energy, governance in the past has not always been good. But think about this. If we really are to go to a world where we can combat climate change, where we do promote diversity properly, look after, and we do try to spread some of the wealth in these less fortunate areas where some of these mining operations are situated, ultimately, you can't just say, ignore these companies, never invest in them. That is not the right approach. I believe the approach of an ESG Mark II strategy would be to engage with the companies. And this is exactly, I think, what more enlightened ESG funds are now doing, saying, look, it's not just about where they are today in terms of their ESG scores. They may not be fantastic today as a miner, because they're still digging holes in the ground, creating a bit of pollution. But it's more about how they're changing, how they're trying to improve, and how they're trying to help improve their corporate governance. So working in the interest of the shareholder. How are they trying to reduce the pollution that they create? How are they trying to be more efficient? How are they trying to engage more with local communities, employ more of the local communities, and involve the local communities as stakeholders in the business? And we've heard today from Caledonia now that they work very hard at that sort of thing. And this is what we call the Mark II, more about the transition. It's not just about taking a snapshot of where the company is today in terms of these ESG criteria. It's how, over time, they're making great efforts to improve their scores, to improve their ratings on each of the ESG criteria. And I think that's important. And when you look at a lot of these mining companies, you suddenly find, well, actually, they're doing rather a good job of that. Not only are they communicating, but we hear about the projects, we hear about the way they engage the local communities, they employ the local communities, they try to boost education, healthcare, clean water, all sorts of things. And again, we hear more at corporate governance and how that is improving as well, and how these companies are not just being run on a sort of boom and bust cycle, but where the directors and the executives are taking a much longer view of the investment cycle and trying to be much more rigid and reasonable, I think, about how they use that cash flow and make sure some of that cash flow hopefully gets back to the shareholder in the form of dividends or share buybacks or whatever at the end of the day. And I think that is a big change. And I think the other thing we should mention before I run out of time is, of course, the most important point of all, which is that how the hell do you expect, as John said, how the hell do you expect to get renewable energy working, wind turbines, solar panels, if you don't invest, if you don't buy and use these metals, whether it be silver for electrical conductivity in solar panels, whether it be copper, we've heard about copper in electric vehicles, whether it be lithium and cobalt for the batteries or nickel. I mean, how does Tesla build a car without all of these components? How is a solar panel created without all of these components? And I haven't even mentioned tin or vanadium. I mean, there's just a whole host of metals, as we've heard, all of which are necessary if we are to transition to a lower carbon world. So ultimately, is ESG on the one hand and commodities on the other hand, are they a paradox? The answer is obviously not. They go together. They go together, but you can still try to pick the companies at least that are trying to improve in terms of the environmental, social, and governance characteristics as best they can. And it's that journey, and we as shareholders should be there encouraging them on that journey and pushing them to go the right way. And I think that is a much more fruitful approach to get even the bad actors to improve than just to reward the good actors for being good and avoid commodities altogether. I think that is just simply the wrong approach. It's very short-sighted. You need second order thinking. And second order thinking for me involves investing actually quite heavily in specific commodity plays today. And there, David, I think it's now past, so I am going to stop.
Brilliant timing there, Edmund. And just to mention, of course, Edmund, that you'll be joining us on the panel. So if anybody's got questions for you, I'm sure they'll come up. Use the Q&A box, guys. That's great. And we've got a poll now we're going to launch. So here it goes. This is for the audience. Right, there's the results. I hope you saw those.
Excellent. I think they got the message mostly.
Yeah, they did. Well done, Edmund. Well done.
Thank you.
And we'll see you again shortly. Now
indeed, David. Thank you.
Our final company presentation of the evening. This one's AfriTin, which probably says it all in the name. Is here we go. Here's Anthony. Excellent. And Anthony's in Johannesburg, so we're in the final leg of our journey almost with you there, Anthony.
Yes, evening, David.
Around the world.
Yeah, thank you very much for having me, and thank you for Mello for hosting this event. It comes at quite an opportune time for our company. You know, we've come through quite a hectic phase of building a mine during the course of the pandemic. But we've had it's been a remarkable achievement getting into production. My team's really come together and pulled a rabbit out the hat, and we've achieved steady state production. And I'm sure that it won't go amiss to many people out there that tin is been performing phenomenally on the London Metal Exchange and in the world in general. It's just the pinch point in the market dynamics coming together, and that has resulted in us and the AfriTin share price increasing by 170% to date, which is also a remarkable achievement, and it's only the beginning for what we believe is a really exciting project. So just to give you a bit of background, we are, as we say, a tin mining company. Our ambition is to become the tin champion of Africa and produce a significant amount of concentrate for the world market. Our flagship asset is in Namibia. It used to be one of the biggest open cast tin mines in the world. We've done a lot in our short time since we've been listed in November 2017. We've confirmed the historic resource. We've gone into production, achieved nameplates, capacity. We've secured an offtake with one of the biggest offtake partners, and you know, we've also concurrent with that declared the first resource of lithium and tantalum that was never historically mined. And the lithium deposit in particular is comparable with some of the biggest hard rock lithium mines in the world. So what started off as a purely tin project has the capacity to become a globally significant battery and energy technology company. So as Edmund alluded to, you know, ESG is high up on our list, which is why I choose to speak about it first. We engage very prominently with our local communities. In fact, most of our employees come from our local communities, from the region and from Namibia in general. In fact, 99% of our workforce is actually all Namibian. We are in an environmentally sensitive area, and we contribute quite significantly to the preservation of the desert lions, and the desert elephants, and the desert rhinos. We are a significant taxpayer in Namibia, and an employer, and we adhere to the highest forms of governance. So just to tell you all a little bit about tin, it's often the forgotten metal, but incredibly important in modern technology. In fact, it's one of the preeminent metals for new technology. Its main use being is a solder in electric equipment, and more particular in semiconductors. So all of your microchips, which is going to be a very important part in new electric vehicles. With that, there's a very small supply of industrial scale tin mining in the world that's conflict free. A lot of what you'll see in conflict minerals involves tin, tantalite, and tungsten, and these are typically mined in difficult areas. You'll see in places like the DRC, like Myanmar, very difficult to get tin production and logistics out of those areas. So there's a real pinch point that's evolved in the market, and that's why we've seen the tin price reach phenomenally high levels. And luckily enough, it's hit the same time as our steady state production, and our share price has increased dramatically with that. But what is turning out to be even more exciting is our byproducts. These are the real cream on the cake. These will be mined and already are being mined as part of the tin production, and these will be separated and created as their own economic streams, and in some cases, like the lithium, may even surpass our wildest expectations in terms of revenue. So there's a picture of our pit. So let's talk about our projects. We're in Namibia. It's one of the best mining jurisdictions in Africa. It's got some of the biggest uranium mines in the world. It's existing infrastructure, a very stable mining code, and a very welcoming government for investment, especially into mining projects. We're in a very unique geological region where we've got these large pegmatite belts that are essentially historic lava flows, and they were intruded by a number of different elements, these being tin, tantalum, niobium, lithium, and beryllium. These occurrences occurred over hundreds of kilometers, where there were a number of historic mines, the largest of which was the old Uis tin mine, and that is what we've got. And more significantly, or more recently, is that we've also picked up some surrounding deposits, and those are also showing really strong potential for future production. But Uis is our flagship. It was at one stage the largest hard rock open cast tin mine in the world. It's a conflict-free deposit. We've got relatively straightforward metallurgy. And what we've done, as I mentioned, is we've declared a resource of tin, a maiden resource on lithium, and we've gone into early stage production, and we want to increase this phase one, and we want to expand the phase one production, and then move into a much larger scale phase two. So as I said, we've declared a resource of 71 million tons, grading at 0.134. That gives us a tin inventory of around about 100,000 tons of tin metal. This puts our tin inventory on just the one pit as one of the biggest tin inventories by resource size in the world, and this was confirmed and declared in the last 12 months. But significantly as well, we've also declared a resource of 450,000 tons of contained lithium. So that's 71 million tons of ore, grading at 0.63%, which is a globally significant lithium resource. In fact, comparable with some of the biggest hard rock lithium deposits in the world. And obviously in tantalum, which is an incredibly high value element, also used in new technologies. So we have a whole smorgasbord of battery technology or battery metals that will be used quite extensively in new technologies. And but what's important is that we're already in production and already making money. So, and just to put things into perspective, so these as I mentioned, these pegmatite belts run for sort of hundreds of kilometers. We've got a 225 square kilometer license area, and what the old timers would do is they'd find a historic pit or a historic outcropping pegmatite. They would mine it, and they mined over 12 different pits. The V1, V2 pit that you can see in the diagram there is where we declared the resource. So that was one of the 12 pits. We have a potential to expand this resource by 3 or 4 times, given the historic numbers that we have at hand. But in addition to that, there's another 180 outcropping pegmatites within our license area. So this is an absolutely huge deposit that will be literally mined for decades to come, and with a multi-commodity will be incredibly profitable as we go through the processes of expanding excuse me, expanding the mining footprint. The mining is relatively straightforward. So everything in white is your pegmatite. The pegmatites stretch for hundreds of meters, as opposed to your typical smaller veins that you get in Central Africa. We get really good liberation from the host rock, so it's very efficient. Low requirement for crushing. The ore is separated basically in the first stage of separation. So we're upgrading the ore quite dramatically before we put it through the concentrator. The coarse nature of this means that the efficiency of the plant is really high, which means lower power costs and lower water requirements. The tantalum occurs together with the tin, so it's very easy to separate at the back end. It's just a matter of liberating the two crystals from one another. And the lithium currently we embarrassingly throwing away onto the dump, but as soon as we've got a good handle on the actual metallurgy, we'll be adding that lithium stream onto our production profile. So really a lot of upside, a lot of good news coming up for the company, and all this while we're producing cash and shipping tin concentrates to the smelters. So, we had a relatively slow start, unfortunately, last year. A lot of what happened around the pandemic slowed us down. A lot of our suppliers weren't up and running, and we weren't able to get parts to the mine. But subsequent to that, we had a dramatic uptick. In fact, the mine is producing a steady state. We are producing a very clean concentrate, so we're getting a 94% payability, which means that for all the tin that's contained in our concentrate, which is about 65% tin metal, we're getting 94% of the LME price, so which is very unique. We're very close to infrastructure, so we don't have to go through jungles or difficult areas to get to port, which reduces our processing costs quite dramatically. In fact, it only works out to about $150 a ton to ship the ore all the way from Namibia to Thailand. So really good economics that are coming out of there. We are working on getting our efficiencies in the plant, and once we've got that, we'll be able to produce a relatively decent C1 cost just on the tin alone. So where we are at the moment, we are in production. Phase 1 is operating in some cases even better than what we're anticipating. We are getting higher grades than in the specific zone that we'll be mining for the next 5 years, which is really very exciting for us. We want to expand this and get the profitability up, add the lithium in, bring the tantalum on stream, and then increase the efficiencies of the plant. This will give us a strong backdrop for phase 2, which will be a much bigger operation. In fact, if 6 to 8 times bigger than currently where we are, and this phase of phase 2 will be significantly de-risked by the work that we've done in phase 1. And we've already got debt facilities in place, and we'll be looking to expand that with the local banks in country. So what AfriTin gives you is not only a tin asset, but what's turning into a battery metal asset of global significance that's in production, and that we want to expand, and something that we can all be really proud of putting together. And with that, we want to be the preeminent battery metal company on AIM. So thank you very much for your time, and if there are any further questions, happy to answer any of those.
Yes, hello there. So if we could just reel you back a little bit, because you've given us fantastic detail about the company. I mean, I just wanted to reel us back because, funnily enough, we haven't heard a lot about tin this evening. And yet, as you said, it's incredibly important. Now, of course, as you mentioned, the producers of tin in the world, the primary producers of tin are, as you said, China, Indonesia, and Myanmar. And
Yes.
China in particular is the key one, because, of course, they don't just produce a lot of tin, but they also use huge amounts of tin. Now, just for the benefit of the audience who may not be tin aficionados, I have to admit, I've been looking to AfriTin for quite a while, and I'm really angry with myself because I kept looking at you guys, and the fact that you're not quite in profit yet always holds me back. And it was a big mistake because, of course, the share price tells its own story, and I'm gutted. But never mind, they may give another chance. It's never too late, you're going to tell me.
It's never too late, and we're still early days.
Exactly. But the first question I had for you about China in particular is, how do you see 2021 and 2022 in terms of the import versus export? Because clearly in the past they have been an exporter of tin, because they have the most, well, together with the other two countries, the biggest production in the world by far. But recently they've turned back into an importer. Do you see them remaining an importer in 2021 and 2022? Because obviously they're the biggest swing importer-exporter on the global scale.
Yeah. So look, they're also one of the biggest users, but there are a number of other avenues in terms of tin use. First of all, so they are not the only tin user. So yes, they are the biggest producer. They have been hit quite dramatically by the pandemic, with the floods on the Yangtze River. That had a huge impact on production. I do see that the tin market is going to be in a deficit. Bear in mind, a lot of their mines are, in fact, I'd say 60 to 70% of the world's mines are underground. We are one of only 2 open cast tin mines in the world. So I think that they're going to have a lot of issues around underground supply, safety, environment. That's taking an increasing role coming forward. And I think that that there will always be big producers, but I think that their reliance on their homegrown production will diminish as these environmental and other factors come to the fore. So I do foresee for the next 2 years at least, I think that there will be importers, but as production normalizes, they probably will get some production back on stream, but I do see it as a diminishing production.
Yep. And in terms of Namibia, because obviously you're based in Namibia, and I know in the appendix to your slides, you say it's a very stable jurisdiction within Africa, but of course, again, the audience might not know much about Namibia.
Yeah.
must admit, I'm not the. I know they've got a cricket team. But I don't know much about Namibia. And I know that's probably because it is rather stable. And if it wasn't stable, we would have heard about it by now.
Yes.
But maybe you could just give us a couple of words on why it's. I mean, because I notice on the global scores in terms of political stability, it's not brilliant, but it's not bad. It's actually, as African countries go, it's quite good. And I was comparing you guys to AfriTin Resources, for instance, who are in the Democratic Republic of Congo, which obviously scores a lot worse than Namibia. So maybe you could just give us a couple of words on that.
Yeah, so look, I mean, Namibia is an incredible place, and I must highly recommend it to everybody to go and visit. It's one of the most beautiful countries out there. It's incredibly vast. There's about 2 million people in the country, and it's an incredibly huge country. Just the province that we're in is the size of Belgium, and there's only 150,000 people in there. So, you know, that they are incredibly welcoming of investors. They've got a very strong fiscal and regulatory regime. You know, so the mineral law is really tight. They've got a very strong legal system. So you know, everything that you need as a long-term investor is there. We've got you know, our colleagues in AfriTin, you know, that they've done a fantastic job for where they are in the middle of the jungle with rebels around them. You know, and I take my hat off to them. We're incredibly blessed. You know, from a logistics point of view, supplier. You know, we're in a mining country. We open cast, they're underground. We've got a strong access to the port with existing roads. You know, so it's got all the right elements to allow for the expansion that we're planning.
Of course, the sort of $1 million question is always the same one. It's obviously you've been building up, obviously running at a loss because you're in the development phase. But now you seem to be getting very close to breaking into cash flow positive, profit positive, and moving into that sort of real production and and of course that would make shareholders a lot more comfortable with investing with yourselves, because instead of being maybe a jam tomorrow company, you're now a jam today company.
Exactly.
What sort of guidance? I know you can't give precise guidance, obviously, but what sort of guidance can you give us for the path we're looking forwards in terms of moving to that sort of more positive cash flow and earning streams?
Well, look at, and I mean, obviously all disclaimers and what have you out there. You know, we operationally we're already cash flow positive. You know, so it's. There are efficiencies in the plant that we want to work on, specifically around recoveries and plant availability. You know, we've got a relatively young team on side. You know, because we've absorbed a lot of the local workforce, and they've been phenomenal. You know, so but what we need to do now is get the availability of the plant and our engineering up to scratch. And as soon as that happens, you know, we've got the benefits of economies of scale with our plant. So it's and the deposit itself, you know, it's just basically scratching off the surface. So as soon as we get those efficiencies in the plant, you know, the group positivity and cash flow will come through. And look, I mean, the tin prices are out of our wildest dreams. You know, we were budgeting on a $19,000 tin price. So, you know, when you at $30,000, you know, there's a lot of meat in that bone.
Yeah. And of course, we haven't even talked about the lithium. And of course, that's a longer term story, but that's got to be the sort of cherry on the icing on the cherry on the icing is particularly the lithium, which of course is going to get everyone very excited.
Absolutely, Edmund. You know, when the old timers mined this deposit, there was never any record of lithium. They didn't even test for it. And so when we did our confirmatory drilling program, we tested for a whole array of elements, not just tin. And that's where we came up with the tantalite resource and the lithium resource. And I mean, if you look at the tonnages of our hard rock lithium and the grades, you know, this could actually become one of the biggest lithium mines in the world. So, and we're already in production, which a lot of our other colleagues, are dreaming about at this stage. We're probably about 12 months away from producing our first lithium concentrate to sell in the world market.
Yeah, sorry, I'm just looking at a lot of questions here. So I'll just pick one or two because I don't think we have very much time left. But here's one. What happened to Malaysian tin mines? They used to dredge in the 1950s, some open pits too. Then the labour cost stopped them being competitive with China. Now, however, there must be some residues in the rivers. The price must justify exploring. Any projects that you know of, obviously.
Yeah. So what's very interesting is Thailand and Malaysia still have the biggest tin smelters in the world. In fact, we sell to Taseko, and what a lesser known fact of Phuket, where the island of Phuket was actually a big tin. The main economy driver there was tin production. So all of our tin goes actually to the smelter in Phuket. But because of the dredging, those deposits are long sort of or no longer viable. It's environmentally atrocious. To go and dredge out there. I think even Indonesia, they still do quite a lot of dredging, and some of their sort of artisanal type of operations are still in operation. But for my money to bring an industrial scale tin mine on board, you're going to need to go hard rock, and there's very few of those around. And I'm very proud to say that we are one of the few that have actually got it right.
Yeah, and on the lithium, another question we've had a couple of questions on the lithium. One question is, would you look for a partner, or do you feel you have the expertise and have the cash flow and the investment possibility to do it all yourself, or do you think you would look for a partner to maybe accelerate that process?
No, I'll keep it all to myself. Why give it away? No. It's look. We'll obviously look for a possibly a technology partner, in terms of upgrading to lithium carbonate, upgrading our concentrate to lithium carbonate. But right now, all indications are we'll be able to sell our lithium spec on the world market. So we'll keep that. It's a relatively straightforward at this stage, but my process engineers always overcomplicate things. I hope they're not listening. But it's a relatively straightforward process to extract it. So we'll do it ourselves, like we've done it, like we've done with the tin.
And on the lithium grades, I must admit, I have no concept of what's a good grade or bad grade. If you could just try to sort of, in a couple of words, just explain to us what is a good grade and bad grade and where you are now.
So pretty much an economic grade in your hard rock lithium runs from 0.5 to about 1% plus, and bearing in mind that's a primary lithium deposit. We'll be doing it. We'll be mining it anyway. Our grade is 0.63%. So still, but what we do have that is a differentiator. We've got 71 million tons of this in just one of our pits. So it's not only do we have an economic grade, but we've just got a huge deposit. So our grade is 0.63%. So it's globally competitive, and we're mining it anyway. We're throwing it away.
I was going to say, so presumably the cost of actually transforming that, or the all-in sustaining cost of the lithium side would be cheaper because you've already mined it for the tin anyway, and you've got this stuff lying around which you can then reprocess for the lithium. Is that correct?
100%. That's right, Edmund. So it's just really cream on the cake.
Yeah, I'm sort of wondering, I have to say, I'm being a bit naughty, but I'm sort of wondering why a really big producer of lithium wouldn't come in and just buy you guys out and send you off to a happy retirement. Or am I smoking something there?
No. Look, I'm sure we'll become very attractive to, you see what you know, guys like Mick Davis are going around chasing battery metals. But you know, we want to build a mining company. We are miners. We want to dig holes, and we want to make money for our shareholders. That's the bottom line.
Perfect. Well, I'm not sure we have. I think I've been through the key questions. Let me just check one last time if there's any others. No, I think we are good. Well, can I just thank you very much for your time? I found it illuminating, and you've just really driven that dagger into my heart. Why didn't I buy you guys when I first looked at you? I'm doubly gutted now, but thank you very much.
Edmund, you can phone your broker. You can phone your broker tomorrow and get in. It's not too late.
I may well have to do that. Thank you very much.
All right.
Just out of interest, while you're on, Anthony.
Yes.
What are you seeing as driving the current tin price surge?
So look, there's a number of factors. So last year, what happened is during COVID, you know, there was a big anticipation that the tin, you know, the demand for tin, which is all your consumer goods basically, because, you know, as I mentioned, your tin is used in all of your chips for your phones and all of your electronic goods, as well as all of your solders. You know, if in your green electronic board, all those little silver dots is all tin. So a lot of production was taken out of the markets last year from Indonesia. We've also with the floods in China and the pandemic in China took a lot of production out, just because people were anticipating a big drop off in consumer spending. But obviously with the advent of exactly what we're doing now, consumer demand is just gone crazy, and there's an absolute shortage of these semiconductor chips. But what is even more important is the electric vehicles. You'll see Volkswagen today announced that they've got a real shortage of these minerals, you know, or a real shortage of the semiconductors for all of their electric vehicles, and they're going to need tin. So and you know, there's not a lot of tin projects coming on stream. So they're going to need tin. They're going to need lithium. You know, everything that John mentioned earlier. He didn't mention tin, which I will speak to him about next time we have a beer. But you know, there is going to be a huge lack of supply and a huge amount of demand, and we've literally hit a pinch point in the market now where it's just kind of everything's just been brought to the surface, and you know, there's all crazy things happening where your cash price is higher than your 3-month forward price, which is a thing called backwardation. And it's just an absolute anomaly in the market. So everyone talks about how great copper and nickel and cobalt is, but they're forgetting what's happening in the tin and lithium space.
Yeah, brilliant. Okay, well, thanks, Anthony. Thanks again.
Yeah.
While you were explaining that, we've got all our panel developing around you, so that's perfect. And,
okay.
Thank you for taking part tonight, and hope to see you again in the next few months as things develop.
I hope so too, and thank you for having me. I look forward to the panel discussions that are coming ahead.
Yeah, well, we've still got over 250 here on the webinar waiting for the panel as well. So let's turn over to, I think, Mark. We need to introduce you, and if you want to come off mute, that would be good.
Hello, David.
Yeah, everybody else has been introduced already in some form, so maybe you can tell us just a little bit about your role and how you are involved in some of the mining companies and ShareSoc, maybe I mentioned.
Certainly. So unlike the other panelists, I'm just an ordinary private investor. I've been investing in natural resource companies for quite some time now, so have some idea of what to look for and what to avoid.
Yeah.
And I'm also a director of ShareSoc, so we try and make sure that there's a decent environment for investors. We were just meeting with the LSE today, for example, to discuss things like the Hill Review and so on. So we're working hard for the private investor community to look after their interests.
Brilliant. And I think nearly all investors need share stock. I mean, it's like the AA, I always say, of the investor world. And we do get into a few campaigns and battles. And just to mention that your battles were not inflicted by any campaign. Unfortunately, Mark injured himself in a fall the other day, but don't worry, he's fighting fit otherwise. Thanks, great. Okay, and maybe we should start with one or two questions that came up for Amati, because we couldn't get those in earlier. The first one here for you, George. Why would an investor choose to buy the Amati fund over an established fund or trust such as the BlackRock World Mining? And secondly, apologies for not having read the prospectus, but does the fund propose to pay a dividend?
Thanks, David. Yeah, we took a little bit longer than we should. We got so much to talk about. But I think what really differentiates, if you look at mining companies, they tend to be tricky investments in the first place. But then you ask yourself, where can we add value to the sector? We can maybe have a better call than anybody else on certain metals, and I don't think we any better per se than people at BlackRock or some of the other funds of making a call on metal prices. I think Edmund spoke about looking at tin. Nobody knew tin would go through the roof. So you look and you say, well, where else can we add value? Well, we add value by having a rigorous process on seeing what the fundamental value of each company is. And we tend to be contrarian investors, so we're kind of looking at areas that the market's not looking at yet, or they're priced too low relative to spot prices or relative to long-term prices. And that gives you a great entry point, because the sector is great to invest in, but you can lose a lot of money by just getting it at the wrong time, as we all know. So that's one way. And then another way is looking at the growth aspect on exploration and looking at a company. And I think Mark took you through the example of K92, where you really looked at how they were situated. Look at how can this company really grow its NAV substantially over time through what kind of terrain are they in? What are the challenges? So those are the kind of companies you look for. So I think when you look at, say, BlackRock World Fund, a large, and I'm not poking out, my own pension was in the BlackRock World Mining Fund. So, but it's a large fund that is more of what we say is a beta play rather than alpha play. So what we're trying to do here, in the same way as Amati are very successful on UK small companies, we are looking at small to medium companies with a great growth potential. We're looking at those companies that even if metal prices stay flat or start simmering down, you can make those multiple returns by just picking companies that have got a great. So I think when you get a fund that's too large, it's very difficult to participate in these growth companies. As you saw tonight, a lot of the companies are 50 million to 100 or 200 million size. Those are the kind of companies that are really interesting for us, and that's where you can grow this fund over the longer term.
So this question's pretty much for all the panel, really, but obviously the first bit is for you. Given the consistent price increases in all metals last year, do you think starting a new fund, you have missed the boat slightly? Or do you believe that a new 10-year commodity super cycle will massively eclipse the gains made in the past year?
So it's actually a really good question, because I've been 28 years in the markets, in the commodities markets. So I've seen troughs and peaks. And so we've gone through, and as I mentioned earlier, it's the timing that's critical. And personally, I look and I say, well, certain of the commodity prices. So you wait, and that's the to make money in the commodities, you need patience. It will come back to you. The valuations will come back, and as you say, maybe we went into this kind of very short squeeze. I think as the CEO from AfriTin mentioned earlier, saying that it was a specific circumstances that led to a shortage of tin. It was unexpected, and we've got a squeeze on there. And I think one of your earlier panelists said about his share price, Caledonia, went too high too quickly, but then came back to reasonable valuation. So that's a trick. Don't chase things. Wait, and you get back. So the question about the super cycle, it's always tough. I think we have a certain degree, but I'm loath to say it's a super cycle is an above average growth for a number of years, and we're still a little bit premature. We came out of an abnormal situation last year where expectations were too subdued in as far as demand is concerned. You had the effects of COVID, not getting materials around, and then you've had all the stimulus coming in. So the way we look at things, we try and be sober in looking at the metals and saying, okay, what is the long-term sustainable prices, the incentive prices on each metal, and we pick value in that sector. So the short answer is we do think that there's a groundswell lifting all these metal prices. Some have maybe gone up too high, and right across the spectrum we're finding some really good value. So you just got to pick and choose. You've got to be very choosy on the companies that you want to invest in.
Yeah. And how do you feel on that, Edmund? Oh, Mark, you want to say something? Yeah.
Yeah, it was a different question that I wanted to raise for the panel. So I don't know if maybe you don't want me to come off that topic for now, but the question was, when investing in mining companies, a very important factor in my experience is jurisdiction. That some jurisdictions are much easier than others. And I just wondered if the other panel members had any views about jurisdictions they would be very reluctant to invest in, or whether they're quite open and take it on a case-by-case basis.
Right. Yeah, we can.
Well, I can kick off with that one, Mark.
Yeah.
So I think the answer for me is jurisdiction is hugely important. As I said, if you look at silver, for instance, I would much prefer to go to North America, Canada in particular, or the US than anywhere else for exactly that reason, because I think there are a couple of things here. Firstly, there are the worries that, obviously the usual geopolitical worries that you might have, you might have the mine confiscated by a new government or a coup d'etat, and these things can happen and probably happen more frequently than we like to care to admit. So that's one thing. Second thing, of course, is that taxation. Something as boring as taxation can change very radically. And even in South America or Russia, I mean, obviously in Russia, we think about UCOS, about the appropriation, but tax regimes can also change very quickly in a lot of countries. So again, I think valuing a tax regime which is fairly stable and doesn't risk changing radically from one day to the next, even under changing administrations, I think is vitally important. So personally, I am very choosy about jurisdictions. I will allow a small portion of my portfolio to be in jurisdictions I'm not mad keen on. Like I do have Alpha Min Resources, which is a tin producer in, unfortunately, the Democratic Republic of Congo. But that's because tin is an extremely difficult thing to invest in. It's only them and AfriTin, I think, that are really interesting at any scale. But otherwise, I would be very careful.
Yeah, I mean, we share an interest in that jurisdiction, though it is a tricky one, in that I'm an investor in Ivanhoe Mines, who I mean, they've had a fantastic run from the share price point of view, and well, their copper mine in the DRC is going to be quite something.
Exactly.
Should we bring John into this one, because Supercycle, something you mentioned in your talk. So I guess you think there's a start of a supercycle, John?
Yes, I think investors, well, and analysts alike have to reset their thinking on valuations, because well, AfriTin's an example. It has a market cap of about 55 million pounds. But yet it has the opportunity to grow a lot, and we've got tin prices that have almost doubled from where they were. So the opportunity for the valuation to go very much higher is there. And okay, we look at the chart and we say, okay, it's gone up 3 or 4 times, but actually there's no reason why it doesn't go up 10 times, because the value of the cash flow to come off the UIS mine is extraordinary, actually, and there's a lot of expansion that can be done. Just to go back onto the point of jurisdictions, I think it's interesting, some of the panelists here have declared that they've invested in the DRC, the Congo, which is a very difficult place. So this is all about grade and quality of project. So you buy Alphamin because it's a fantastic quality project run by some very good people, even though it's in a terrible country. And I would like to remind everybody that everybody thought the UK was fantastic for North Sea oil production until Margaret Thatcher decided to increase the tax. So no country is safe from politicians changing the rules. And that's why in the mining sector, we actually do consider just about every country going. It happens to be Namibia is a very good and stable country. Most of these places aren't that bad, but remember, you can get caught out even in the US and Canada, although they are good jurisdictions and are generally stable. Given that governments all over the world are going to have to look to bring in some cash from somewhere, nowhere is safe anymore.
John, I mean, John is dead right here. Is that the best returns are sometimes to be had in jurisdictions that are difficult to stomach, and just the way to get around that is diversification in your holdings. Don't put all your bets on one, because these things can happen. So if you're spreading your risks, you should get better returns because they offer better returns, but you don't know which one, but one of these countries are going to blow up.
Yeah. And also, I mean, when you're valuing a mining company, one would apply a discount of some form to allow for the degree of risk you feel there is in their jurisdiction. So that's another way of compensating it. Besides, as you say, diversification is crucial as well. But, you would expect their valuation to be discounted somewhat for political risk, or perceived political risk. Let's put it that way.
What percentage, just a question here, what percentage of one's portfolio should really be in these type of companies, really?
All of it.
All of it.
There speaks a broker. What's a broker? What's a broker?
David, how are you defining these kind of companies? Companies operating in risky regions, or mining companies?
I think just generally mining companies, not necessarily picking the region. You know, a lot of people on the webinar tonight probably are only just working out that it's a good area to go into, or, you know, so do they pick off a number of companies? Do they invest in a fund? You know, all these questions no doubt come up. In fact, one's just flashed up on the screen. Can you give us a feel for which natural resources investment trusts are the best way to play the commodity boom?
I mean, in terms of allocation, I was just checking, and my current target allocation to natural resources is 15% of my portfolio, based on the sort of macroeconomic factors that were there. I'm comfortable with that. Most of that, I must admit, is in investment trusts. Yeah. BlackRock being one, and well, two different BlackRock trusts are my main investments there, but I have a couple of individual mining investments as well.
I mean,
I'd
about
say,
you,
Dave,
Edmund, what percentage?
I would say, David, that varies enormously through the cycle. I'd pick up on our good friends from Amati, you know, investing through the cycle, but I'd spread that. I'd say I go further than that. I'd say there are times in the cycle when you really don't want miners or oil companies at all, and there are times when you want shed loads if you can stomach the risk. I mean, obviously, let's not forget, especially with smaller companies, there is huge volatility involved, right? So you've got to be able to stomach the risk and sit in your hands and try not to do very much for a long time and be patient. I think you know, as our friend at Amati said, patience is at a massive premium, particularly with mining companies, because they are so volatile and often act a little bit, especially the small ones, act like warrants. They may do nothing for a long period of time, and then when you almost forget about them, and then one day something will happen, like the tin, and then boom, off they go to the races, and you'll be very happy you didn't sell because you were bored. At the moment, I've actually moved up my allocation quite aggressively. I'm a little bit more aggressive than Mark. I would probably say my target allocation, and I don't want to worry you too much, but it's probably not far short of 50%.
Wow.
Yeah, I was at a very small amount a couple of years ago. Actually, Caledonia Mining was one of the few companies I've held for a very long time, and I've always loved that management, despite the fact they're in Zimbabwe. But I've added a lot, both in precious metals and industrial metals, and also in uranium. I throw uranium in because, again, on the concept of, okay, if we go to all drive electric cars, where the hell does the electricity come from? And it's not all going to come from solar and wind, because what do you do, as John said, what do you do when the wind doesn't blow and the sun doesn't shine? Where does the electricity come from? Where does the base load come from? And I think nuclear power has got a terrible rap, obviously, because of 3 Mile Island, Chernobyl, Fukushima, and so on. But actually, even according to the economists, it's one of the safest forms of electricity generation. If you think about, you know, getting the stuff out the ground to actually getting the electricity, or the steam turning to turbines to produce the electricity, you've actually had the lowest number of deaths for the amount of electricity production you get compared to coal mining, oil, natural gas, whatever. So, you know, again, it has a very bad rap, but ultimately, you know, we're going to have to embrace some very hard decisions if we are serious about climate change.
And I think just to elaborate on that point, there's more radiation released from coal-fired power stations than from nuclear ones.
Yeah, it's just, you know, I mean, there's a narrative. There is a narrative there, which I think gives the patient and the contrarian investor an opportunity at the moment.
George is going to like this one, because 2 people in the audience have both asked the same question. Please, can you provide the stock symbol for the TB Strategic Metals Fund?
I like that one. Thanks very much. I've got the ISIN code. You'll see it on it's on all the platforms. So Hargreaves Lansdowne, Igon, a number of the platforms. So it will be the Amati Strategic Metals Fund. The ISIN code is quite long. I can type it and
don't worry. We'll make sure we provide it in the wrap up. Yeah.
I just to Edmund's point as well about allocation, and I try to show that longer term commodities against the broader markets. And the reason why we're sitting and having this discussion today, and why we're excited about the metals, is it's a sector that hasn't attracted investment for 20-30 years, and it's the underinvestment at the same time as demand is picking up. There's a structural change in demand. This is why we're sitting where we are now, and the supply can't meet demand, and we're getting these pop-ups, and that's why we think we're going to have quite a nice growth phase in the sector. New players are going to pop up, and that's where the excitement comes in. So, you know, the allocation part is your risk profile, and where else are you going to put your money to work right now.
So George, sorry David, could I just jump in and ask George a question I was dying to ask, because you showed that chart, 3 charts in fact, on the different cycles, early, middle and late. So where are we? Where's your money going now? Is it early or is it middle? I'm guessing it's not late.
Well, it's actually quite
confusing for us now, because usually, and I worked for many years for Old Mutual Asset Managers, which is really invested in commodities. So you used to have these beautiful cycles in commodities, 3-4 years, and you knew which ones came afterwards. It was first precious metals, a couple of years later, platinum, palladium, a couple of years later, it was the base metals. And this time round, we've gone so quick in such a short period of time because of what Anthony was mentioning. There was a shortage of tin on the demand side, and also on the supply side, where producers thought, well, it's the end of the world, it's going to be. So I think we've sort of had a intermediate peak, and we'll come back, we'll settle somewhere, and then we'll have a much more grounded growth in prices coming back. But it's very confusing I mean, the volatility we're seeing in prices is just unheard of. It's difficult to navigate your way through this, and that's why I say just step back, just look what because miners, you got to look at the incentive prices, because like lithium, for example, and we heard from a tin operation saying there's plenty of lithium. There is plenty of lithium around. It's depends at what price producers are willing to think about longer term on the prices. And that's why prices will drift back. So I think we just got an intermediate peak. I think in some of the prices where maybe the heats, it's been some prices moved up too quickly too, and we'll have to drift down, get to a stable price and move. But not all of them. I mean, there's some prices like platinum. I said, okay, that looked ridiculously cheap compared to palladium, for example, and rhodium. So, and nickel was the other one that I think John mentioned earlier as well, that came back, and it was ready to move relative to copper. So we're jostling for position. I think the race hasn't properly started, and some horses have bolted out first, or come back in, and then we'll have a proper move forward. That's my view. Sorry,
what do you think, John? Where are we?
Yeah, I think we're right at the beginning of this. I think there's a few reasons for that. Although China was very quick to get its stimulus programs up and running, some of those projects are really only just getting going. Joe Biden's Go Big stimulus in the States has only just been approved. And okay, a certain amount of that is just cash distribution to people. Heaven above. I mean, I don't think any politician in the UK would ever give us any cash, but it will it takes time for the big stimulus construction projects to get going. And so the metals for those projects still needs to be produced. So although companies and factories are starting to gear up and to restock, there's really, we're really at the start of that phase. The UK has been quite good and quite quick for once at getting going. And that's partly because the government is, shall we say, led and pushed and pulled by some big business interests that wouldn't want their names mentioned, but actually have recognized for some time that the way to kickstart an economy is through construction. And that's one of the reasons why the HS2 project has continued throughout the coronavirus crisis and through the lockdowns. When we look at Europe, they are painfully slow at getting things done. I mean, what's going on with the vaccine rollout in Europe is just one example of many issues that the European Union has at actually pushing out stimulus, pushing out rescue plans. But it will come, because they're a very big organization and group of countries, and they do like to build roads and bridges, particularly into Eastern Europe, particularly to better connect Europe and pull it together. So more metal, more commodities will be sucked into all of that as we go forwards. And I think that process, that if you think back to the subprime crisis known as the global financial crisis, and you think of what happened after Lehman Brothers went down, we had a boom that lasted 2-3 years, certainly in the mining sector, And that crisis wasn't nearly as large as the crisis that we're coming out of now. So I think we're going to see stimulus running for 4 to 5 years from here. And I think, and when we know it's much bigger, I mean, we were adding it up last year on a regular basis. We got up to just shy of $20 trillion of stimulus funding that was pledged. And that is so much bigger than we have ever seen before.
Great, thank you, John. And another question in here, where will electricity storage come into this? Keith asks.
Look, not wanting to monopolize on this, Anthony Verjolen will be able to talk about it because he's a director of Bushveld Minerals, or was, which produces vanadium for vanadium redox batteries. So that's one option. Lithium ion battery for grid storage will remain. It's very good for very rapid reaction. And we know that these sorts of battery systems are going to be very important. I mean, there are a few other types there. I mean, there's a hydropower system, and SoftBank were developing something that lifts 25-ton blocks of concrete and then drops them with a crane, which personally I think is a bonkers idea, but I guess you've got to try anything. But for me, the big batteries are going to be important for grid stability.
Yeah. Any thoughts on that, Edmund?
Well, I think one of the issues we have is we're going to be embracing a number of alternative technologies. And I think if we think about, for instance, electric vehicles, it's all very well to say everyone's going to be driving around with a lithium-ion battery. Well, if you're a heavy truck, it makes sense, because a heavy truck carries several tons and you need range. And the one thing you know about electric cars is you tend to get range anxiety. So it could well be that we get a hybrid solution, like for passenger cars. We use lithium-ion Teslas, Volkswagen, and so on, as we know now, or hybrids. But for trucks and buses, maybe we do need to go the hydrogen fuel cell route, because again, you need the range, and that's something we just don't have the technology for today. So I think that's one. I think that's another issue. And in terms of storage, you know, I mean, John poo-poos the gravity storage with the concrete blocks, but it's a very elegant, low-tech solution. So he might think it's bonkers, but you know what? It has one very, very big advantage. It's blooming cheap to put into practice. You know, you just need concrete blocks and a crane and a big hole. That's it. Doesn't need anything more high-tech than that.
Yeah. Any thoughts, George?
I mean, I've also seen some with trains in the US. They've got these train tracks going up, and then they run these trains up there to the top of the hill and during the day, and then at night it slowly comes down and regenerates the feeds power into the grid. But the only thought on that is that it's definitely the way that the world's going, and the technology is changing so rapidly at the moment. I mean, you've seen just with the battery, it's almost every year there's a new mix of commodities that you want to put into the battery to get the best efficiency. There's enough incentive for the scientists and engineers working on this to find the best solution. So we're sitting out here today and saying where we're going to be in 5 years' time. I think it's going to look a little bit different to what we think right now. We've just got to keep, but this is definitely a way, and it's going to use metals, going to use different metals in different degree. But we're just going to have to keep a close tab, because this is the future. So, Edmund, you were saying about the hydrogen fuel cells. Yes, it may be. Again, it becomes on price. It becomes thrifting. It becomes innovation that comes through. So it'll be interesting to see, and that's the exciting part. But we can't live in a world without the metals. That's the thing that I think everybody on this call knows today. So
but I think that's the point, isn't it? The speed of innovation is such that trying to predict 3 to 5 years out is a bit of a monk's game, and we all know that. It's like trying to forecast a company's earnings 3 or 5 years out. Bit of a monk's game, really. We're sort of forced to do it, but we all know it's a bit of a monk's game. We all know we're going to be wrong, and I think George is right. Just keep your eye on the ball. The target will be constantly moving, and so we're going to have to keep tracking it.
Yeah. Anything to add, Mark, or shall I just end with gold next?
Not really on that topic.
Okay, well, seeing as our original event was gold in November, and the theme a little bit of this event is still to look at gold, what on earth has happened to the price there? I mean, where do we think that will be going? It's in a downtrend now. Where is it going from here, I wonder?
Well, I'll stick my flag in the sand and say I'm bullish. I still think we go back over 2000 much higher, but my personal feeling is if you believe that story, but you like the industrial demand story, you can get both with a combination of silver, platinum, palladium, and maybe a little bit of rhodium. And we know about the Sylvania Platinums of this world. That could still be interesting.
Yeah. What do you think, George?
Yeah, I share the bullish stance here. That, and again, we look at the metal, the gold and silver, very much as a monetary asset. And so, to be negative on gold and silver, you got to be really bullish on the dollar and the euro. And you're seeing all the stimulus, and you scratch your head and say, well, in real terms, are these currencies? Because the incentive from every central bank, they've built up all this debt. They're printing a lot of money. They're saying we may stop printing, but the incentive is to keep printing, especially as rates are starting to rise. So I think we're in a transition phase from last year. A lot of investors bought gold as a safe haven against the end of the world and it's a doomsday scenario. And after October, then you saw the gold price drifting back, and it was moved into industrial metals. And I think the next shift will be into as a hedge on inflation, and that's not apparent yet. There's a lot of debate. I would say you're reading economists, probably 9 out of 10 or 8 out of 10 are still, yeah, we're not going to get real inflation coming through. So there's still a question mark on whether we're really going to, and we haven't seen so we're in that holding pattern right now. But what's happening is nominal rates are going up, and a lot of algorithms are just coming in and saying, nominal rates rise, sell gold. It's really real rates that affect gold. So I think we've been testing the bottom. Yeah, hopefully we could still see a little bit more downside in the short term, but I'd be very surprised if we don't start pushing 1900 towards 2000 over the next 12 months. So if you're looking at investment saying, well, I don't know, gold's tricky to always call and hate getting sucked into the timing, but fundamentally I do see it. If it's not 12 months, it's 24 months. And if you're prepared, then you look and say, yeah, you want to be looking at the gold sector.
Have you any thoughts on gold, Mark?
Well, I broadly agree with what Ed and George were saying. I do look at the price closely, as I do have investments in that sector, and it looks to me, just based on the charts, that it might be bottoming out now. And as you say, the inflation argument is the key reason why it should move forward. The only potential fly in the ointment is I do get a feeling that some investors have been switching from gold to cryptocurrencies. But
I knew you were going to say that, Mark.
I knew Bitcoin would get in here.
I was going to say, I was waiting.
I know. I mean, just looking at what's been happening with gold ETFs, and I suspect there's been flows in that direction. Of course, that could very easily reverse if the scales fall from people's eyes on cryptos. But I think that's been one factor in price moves lately. Don't know if the other panelists agree.
Yeah.
What's your thoughts, John?
I think the current thinking is to buy the dips on gold. For me, it feels like it will track sideways until there's another crisis event. There's quite a lot of long holders who I think are still liquidating and taking profits. There's probably quite a lot of gold coming out of emerging markets where their currencies have fallen and where they've got huge profits to take on gold. But of course, we are in an uncertain world where some countries will come out of the coronavirus crisis better than others. And countries that are, shall we say, have very poor vaccine take-ups may well continue to suffer serious lockdowns for a while or serious economic impairment. and that will affect their currencies, which will be damaged. And there's always the potential for, because there's quite a lot of companies out there that have got growing debt piles. As governments start to pull back on the emergency liquidity that they've put into the system, some companies are going to discover they haven't got their shorts on, as Warren Buffett would say, and they're going to be some big failures.
Yeah.
I think, David, is the last one point on this, is that just on the equities, what interests me particularly, because you look at the fundamental value of the companies, the equities, a lot of them are discounting 1,200-1,300 gold price. So it's pretty a lonely space for gold investors right now in the equities. So as a contrarian, you look at this, and I track very closely sort of sentiment indicators from general funds around the world, and the sentiment is sort of rock bottom. It's been there twice before in the last 20 years, and that's usually a time when nobody's looking at that space to be picking them up. So it's again the timing issue, and who knows? Gold can go down to 1,200-1,300, but these companies are really discounting that. It's just risk reward is favoring coming into these gold companies right now.
Yeah. Right. Well, I think we've gone 10 minutes over. Everybody's had a fair number of questions. So I'd just like to thank you all really for helping us on this evening of looking at this sector. It's been really good. And I think people will have learned something from it, I'm sure. Maybe we all meet up again in another 6 months. We like to run these every sort of 6 months or so and see where we are. It'd be good to have you back. And thank you very much for joining us tonight. Thank you.
Thank you.
Thank you, David.
And thank you, David, for the invite. Very appreciated.
Great. Well, everyone, that brings us to the end of another Mello evening. It's a sector coverage evening, but we do run our regular Mello Mondays, and I know many of you are new to Mello, so we will be writing to you in the next day or so to give you a bit more information, a special offer to join us, maybe with an annual pass. You'll all be very welcome. We have lots and lots of companies come to us on a Mondays. In fact, George's new company, Amati, they're doing a interview with me on the show this Monday. So lots of coverage. Montanaro, another fund to look at. And we have two great companies on Monday, SCS, which you'll all know in the high street, and a company called Fintel. So you're all welcome to join us again. Keep in touch on the Mello website. And thank you everyone once again for joining us this evening. 304 actually signed in, so that's a lovely number to keep us all happy that we're delivering for you what you like to hear. Thank you.